Hello everyone, welcome to ZaranTech. In today's dynamic financial environment, efficient management of treasury and risk is paramount for organizations. Let us explore SAP FSCM TRM, a solution designed to streamline treasury and risk management processes within the ECC system. SAP Financial Supply Chain Management FSCM, Treasury and Risk Management TRM on ECC is all about optimizing financial processes within an organization. It encompasses managing cash flows, mitigating financial risks, and ensuring compliance with regulations. Studies indicate that companies with strong treasury processes can cut financing costs by up to 20% and enhance cash flow visibility by 30%. In this course, we'll cover the fundamentals of SAP FSCM TRM on ECC, including an overview of treasury and risk management, cash and liquidity management, treasury operations and risk mitigation strategies, compliance and reporting. But before we begin, please subscribe to our YouTube channel and hit the bell icon to receive regular updates from us. Now let us look at the agenda. Agenda 1. Money market. 2. Derivatives. 3. Scope of FSCM. 4. Transaction manager. 5. Money market process. Let's dive in.
To SAP and the non-SAP environment. Okay, so for example, credit and risk management. So as you might know, like we have a different type of rating, customer rating applications or interfaces like DNB, and we have ABC also. Like there are different organizations in US which do customer rating, so we can integrate with them. And same for dispute. Okay, so we have FIS and we have get paid. So these are used to send reminders or different type of notifications to customers that can be connected with this dispute management. So as Helen said, and same for BAM as well, because for that we need to generate bank files, right? So that can be generated in different formats like XML, and now we have a CAM2 as well, because this is well known now in S4, because most of the companies were using MT940 and BAI format. Now they are moving to CAM2, which is a combination of BI2 and MT940. Then better predictability of cash flow. So why we say predictability of cash flow? Because if we use treasury and risk management, if we use CLM, we know from where this cash is coming from, what is the source of this cash, using different characteristics like cash flow or flow types. It will tell us like from where it is coming, whether it is coming from finance, whether it is coming from MM, whether it is coming from treasury. So it will tell us the clarity of this. And based on the value date as well, because when we talk about bank, we don't talk about document date or posting date. We talk about value date. When or at which date it is maturing, we are getting a liquidity in hand. Because most of the company, why they implement treasury, why they implement CLM, so that they can do forecast, right? So on so and so date, how much cash will I generate? So this is the main crux of that. Reduction of working capital, right? So using treasury or FSCM, we can even reduce our working capital, because there are like modules, there are sub-modules, there are components, there are reporting, which can help us building that. Reduction of operating expenses and end-to-end integration of business process. So financial FSCM module is one of the module which is integrated with everything. Like for example, it is integrated with FI, because all the accounting is flowing from FI and to FI. Because as and when we have accounting, it is integrated with FI, right? Then credit management module is integrated with SD module, because we are integrating customer credit rating. Then we have dispute. So dispute is also related to SD, be it FI or be it sales and distribution, core module. Then we have banking. So banking is integrated with everything, because as soon as we have payment or we have collection, so that is where it comes to BAM. And then treasury is again a core module. So we have accounting, so it is related to FI. And what else is left? We have collection, so that is related to customer receipts, right? So this is all integrated, like to one or each other. SAP Treasury and Risk Management is a series of solutions that are geared towards analyzing and optimizing business process in the financial area of company. So that is what I said. Integration. So integration is a big word. So that is how it is integrated with all the modules across all the channels. SAP Treasury and Risk Management is an integrated solution in which the various components are closely linked. The financial transactions managed in the transaction manager can be different. So this is a kind of a flow chart where you can see that like how this is integrated with each other, financial markets, business partner. So now most important thing. So in treasury, we don't talk about the customer, we don't talk about vendors. So its main master data, it starts from business partner. Now in S4, we don't even create customers and vendors, we create only business partners. Okay, so customer, vendor, supplier, or what you call like in a normal financial term, suppliers and customers are no longer required in S4 environment. We only create business partners with different roles. So for example, in IHC, we create as a drawer, we create as a account holder, we create as a electronic bank statement receiver, and in treasury, we create a business partner as a counterparty. Because we give loan, we receive loan, right? Same as in finance, we create a financial supplier, we create a financial customer. Okay, so we have a different type of roles. Same as like in finance, we create vendors and we assign reconciliation account. So you can take that example only. So when we create a business partner, we assign different type of roles. And business partner are independent to company codes. For example, one business partner can be extended to multiple company codes as well. So same number or same business partner can be used across multiple channels, multiple company codes as well. Now in this example, so if you see financial markets, market data management, this is again one of the modules of one of the instrument of treasury, interest rate, FX rate, security price, commodity. And when you see the rates and above that, these are the instruments, commodity, FX, interest rate is the money market, security is again instrument, and volatilities is related to commodity. So these are the interest rates. Then it is linked with risk management because when we create a treasury instrument, we can link that to risk management as well using guarantee or facilities. So that it will provide us a portfolio kind of reporting which will tell us like how credibility this instrument is having in that exposure. So that will provide that detail as well. Then this transaction manager is like very vast, I would say. So all the core configuration of treasury is under transaction manager only. So we can divide this treasury into two parts. One, org structure configuration, that is in general or basic settings, I would say. And then whatever is left, I would say core treasury configuration is part of transaction manager only. So whatever is left, like around 20-25 steps, that is part of transaction manager. We assign GL, we create the money market product types, transaction types, then we have flows, under flows we have conditions, then we have update types. So everything is under transaction. So this is the backbone of treasury. So this is org structure and this is detail configuration of treasury and risk management. And under that we have this integration with IHC, cash management, liquidity planner under this node. So this is the kind of flow. So under transaction manager, so these are the components, management of all financial transaction and positions. So you will see this position word many times when you start treasury. So in treasury, position means like wherever our treasury transactions are going. For example, once we create a treasury deal, let me open an Excel. Okay, so treasury life cycle. So for example, first we create a deal. First of all, like we don't call it a transaction in treasury, we call it a deal. We use transaction FTR create, and that deal can be money market or FX or so and so. So how do we differentiate between money market? So there are different type of products. Okay. So product types can be helpful to differentiate between different instruments. Like if you want to create a money market, then I will use 55U. If I want to create FX, then I will use 60A or 60B. Okay, and if I want to use fixed term deposit, then I will use 55A, something like that. So these are all standard. So if you want to create a new one, we can copy and create a new one. And underneath we have transaction types as well. And what does transaction type mean? So under product type, for example, we are using 55U. This is interest rate instrument. And what is the use of that? So for example, we take loan and we give loan. So this is basically used for loans, intercompany loans, for example. So loans either we take or either we give. So that is investment or borrowing. So investment means we are giving loan, and this is investment for us. We'll get interest on the basis of like our terms, like either we take daily interest or monthly interest or quarterly interest. That is based on what we decide. And then borrowing, we are taking loan and we are giving interest. So investment is 100 transaction type and borrowing is 200. So first, for example, we are creating a deal. We select the product type, then we tell system like, okay, I am investing, so I will be using 100 and then business partner. Then I'm able to see the screen like where I will enter how much nominal amount, like how much is the principal amount which I'm investing, what will be the terms like start date and end date, a rate of interest, whether it is fixed or variable. So there are many things which we need to add on. And after that, once your deal is saved, this will be saved at contract status. That means this is just a draft. This is stage 1. Okay. Then stage 2 is settlement. At this time, for example, like if you check your module, PS module, we create WBS element until unless it is released, you cannot post anything. So same for treasury as well. So until unless it is at contract status, you cannot do. It is as good as Park. Okay. So which is not released for accounting, for example. So once we settle that, that means that is authorized to use. Okay. So then we do TBB1, that is posting. So for example, we have created a interest rate instrument from 1st of January 2021 to 31st of December 2021. Okay. And the amount is 15 lakh. And then rate of interest is say 10% monthly. Okay. So start date is this. Then that means on 1st of Feb, there should be an interest received, right? If that is investment. So as soon as I do TBB1, that is I'm posting to accounting, it should calculate 10% on this and post this much amount. So it will do this posting automatically. And date will be this one, 1st of February, because we have chosen 10% monthly. So first month will end on 1st of February. So 12,500 will be posted automatically. But we need to use this TBB1. So business normally decide to create a batch job. So every day. So on the daily basis, TBB1 will execute and it will post whatever is due that day. So this will post on 1st of February for this interest. Okay, so this is, yeah, normal structure of that. Yeah, any questions?
Ankit, do you have? Yeah. Hi, Mukesh.
Hi. Sorry, it is Rohit. So I think there is some problem with that. So name is not coming right. Yeah. Okay.
For all of us, you are Mukesh right now.
Yeah.
Hi, Rohit.
Okay.
So Rohit, pardon me, I am very new to this system. On the 20 of us on call, I would be the most knowledgeable of this, least knowledgeable of this system.
Okay.
So when you say 55U, 60A, 55A, and TBB1,
right.
Is it when I do a deal entry into the system, will I get, let's say, 55A is investment, bank deposits, fixed deposits.
Interest rate instrument.
Okay, so any instrument, but when I do a deal entry, do I only see codes in the system? Or
no, you will see both. You will see both.
Okay.
Code and description, both. So this is, this is how you create. Okay, so these are normal standard product types which SAP provides, and I don't see when I have created my own, because normally company uses what SAP delivers, right? So this is how it looks, 55 view, but in case you want to use or change the description, you can change the description as well.
Understood.
Yeah. So it will show you both product code, type code, and the description as well.
Understood.
Okay.
Please continue.
Yeah, and this is like, so for example, like this is just a theoretical part. So once we start the configuration, I'll show you in detail, like how that looks and how do we create and what sort of characteristics and what sort of components we have under each product type. How do we differentiate? For example, interest rate instrument, when we call it 55U, what is the difference between 55U and fixed term deposit? So we will discuss that in detail. No worries. Okay. I'm just explaining you the core cycle of treasury, like from where it starts and at what level accounting will be there. Okay.
Great. Yes, good.
Yeah. Okay. So now there is one more thing, very important aspect of posting. So now when we do posting outside, for example, outgoing payment, right? In normal financial term. So that time we will generate a payment request as well. We call it payment request, and because we are paying outside. Once we receive, we don't have payment request because that is a collection, right? So once it is outgoing payment, we'll generate a payment request. Okay. So payment request will be generated at this level only, TBB1. So it will just see, for example, if it is borrowing instead of investment. So borrowing will be we are paying interest. That is outside payment, correct? Even if it is internal, that time also we can generate payment request, because for treasury that is outside, even if it is intercompany also. We can take a decision like to switch off or switch on payment request at any time, but that will be for outgoing only. For incoming, we cannot generate payment request because that is not in nature of generating payment request. So at this level, it will generate a payment request for 12,500. So this will be having a payment request number as well. Say for example, for this one, it is 100. So once we have this payment request generated, then we need to pay off using F111. This is a normal finance transaction, right? So it is the same as F110, but this is using this payment request. Okay? Because when we use F110, that is paying based on the vendor open items. Whatever is due for that vendor which we have selected, or company code or payment method, it will just pay off on that date. But in this case, it is paying based on payment request. Whatever payment request is due on that date, it will select and it will pay. Okay. So it is only for, because F110, F and F111 is only for outgoing payment. So that this is also outgoing payment. Any doubts on this?
No,
Okay.
I think I'm okay.
Yeah. So these are core 4 steps which we do on day and night and every day almost for treasury. But after that we have month end. And we do accruals, valuation, and we do like these two things we do on the time of month end. So we do accruals, which is TPM 44, and this is TPM 18. These two cycles we do. At this level, we post a revaluation entry. For example, we are doing some postings in FX, like company code currency is the euro, and we are creating loans in GBP. So at that time, it will revaluate and it will post FX entries as well, based on whatever FX rate we have entered. And this is accrual. Okay. And then we have TPM1. And this is valuation at the time of month end. So this is the sequence which we need to follow. 2 and 3. Because if we don't do this, we will not be able to post this. Because at this level, it will just generate a revaluation entry. It will not post. And at this level, it will post this entry. We have generated at, or we have parked at step 2. This is independent. Okay. So this is entire life cycle of treasury, I would say. And for that, we have to do a lot of configuration like GL assignment. We have to create update types. That is purely technical. But that is like, once you understood like complete cycle, you will be able to get that like, okay, so this configuration relates to this step and this relates to this step. That we will get to know. Okay.
Hi Rohit, Atul.
Yeah. Mm-hmm. Please tell me.
Is this TPM 18 is a mandatory step? Because I believe in SAP S/4HANA you can use directly TPM 1 to post revaluation as well.
No. It is like for Treasury, there is no change between ECC and S/4HANA. It is exactly same. Yes, for IHC, for CLM, there are a lot of changes because now we are using apps for IHC. But for Treasury and Risk Management, there is no change. So this is mandatory because at this level, we are generating, I would say, I will use generating word, generating or creating positions for FX entries, FX revaluation. We are not doing that, it will give an error at this time. Then we need to go back and we need to execute TPM 18. So this is mandatory. But if you check the flows of any treasury deal, because there are like I would say, there are one business flows, business transaction flows, which are generated based on principal flows. For example, 100, because we have many update types, 100, 1100 plus something like that, or 1100 minus. Okay, so based on that, if we post any FX deal or FX transaction, so it will generate statutory flows as well according to this. Okay, if we have that on so and so date, we have to post that. So maybe in your case, you have switched off these flows which we post at the time of TPMAT. That's what I'm saying, because if you are booking in the same currency, there is no need, right? If you are posting an interest, for example, you are posting an interest and that you are posting in foreign currency. For example, it's not in GBP and it's in Euro. And that time derived business flows will be generated, and based on this 1st of February, for example, you are generating 12,500 and there are derived business flows on this date as well. So there are FX derived business flows. Now you're running month end on 20th of February. 28th of February. You are executing directly TPM1. Then it will give an error that you have derived business flows which are due on 1st of February. First go and execute that, then only you will be able to. So now you have an option. You can still switch off these update types. Okay, so you can either switch on or switch off. If your business does not allow, like we don't want to have a derived business flow, you can switch this off. Or you can mark this as not posted flows. Because there is a screen where you can mark any update types relevant for posting or non-relevant for posting. If you're not marking for relevant for posting, then this step will go off. So if you don't want TPM 18 to go, so you need to switch these derived flows off. If you are having derived flows, that you can see in your TPM 10 report, where it shows like this is your deal and so date, you will have derived flows as well. So if you have derived flows active, you need to first post these derived flow using TPM 18. If you don't have, then directly TPM1 can be used. Yeah, and plus one more thing. So for example, you have different valuation areas as well, or accounting, I would say, principles. Okay, so valuation areas is equal to accounting principles. You have multiple. So based on that, you can design your derived flows, or you can design your update types. So for example, in one valuation area, 0L or leading ledger, or leading ledger. So for example, US GAAP. You want one update type to be relevant for posting. But in other you don't want. You can set that as well. Because same as what we do in asset accounting. So one chart of depreciation is relevant for posting and second is not. You can do that as well. So there are many features. We can avoid posting and we can have relevant for posting. Management of all financial transactions and positions. So these are all positions. So where deals go from one channel to another channel. Support. So position does not mean accounting. So first of all, there is a difference between position and accounting. So all the positions are not relevant for accounting. Okay. Support for trading and back office functions. So in treasury, we have different type of roles, and based on roles, we decide like, okay, so if it is back office, it will do settlement, it will do TBB1, and if it is trading, then it will create a deal. So based on that, we create the roles as well. Front office, back office, and middle, something like that. We create roles. Monitoring, checking, and release. So monitoring means when we create a deal, it is at contract status, and at the time of checking, we do settlement, right? And then once settlement is done, we do transfer to financial accounting, that is TPB1. flexible configuration of company-specific transaction and position management procedure. So this position management procedure is very critical and very purely technical as well, because like there are some configurations which is having derived configurations as well. So normally 99.9% I always use standard one which SAP provides, because this is having a kind of a type of valuations, like how will you perform your valuations and all, how will you do your accruals, something like that. So if you change it, that might cause different inconsistencies. So same as like we have a typical asset accounting module. If you touch your chart of depreciation, you change something, then you will face issues while you're posting depreciation or different type of transactions. Same treasury will work as well. See, derived business flows, for example, you're posting any type of transaction like TBB1, or when you're posting basically any positions in SAP in treasury module. So you will have an option to generate different flows based on what you are posting. For example, you're posting an investment, and that time you have FX transaction. So you want that at that time you want FX flows to be updated, for example, based on the today's date. So for example, you're posting on 1st of February and you're posting in foreign currency. So on that date, rate is different. And you want system should be posting FX entry during month end for that. So you need to generate a derived business flow, so that based on that, it will post your FX entry when you're doing your month end. If you don't have derived business flow, you will not have any FX entry at that time. Assignment of financial transactions to portfolio or transaction management and security. So this is support security, flexible reporting and portfolio analysis. So reporting is like you have all type of reportings which will have just accounting, and one which will having accounting or without accounting. For example, you have a deal. It will give you complete life cycle of a treasury transaction, like this is due on this date, whether this is posted or not. So it will give you everything. Plus we have a payment register as well, like TJ04. It will give you like this is a treasury deal and it is due for payment on this date. So it will have a complete forecast. Okay, yeah. So this is important. So these are the instruments under each product type. Product types under each instrument. Sorry. So money market, these are the instruments. Foreign exchange, these are the instruments. Loans, derivatives, securities, commodities, and this is the main component where we do configuration. So treasury transaction manager, market risk analyzer, credit risk, portfolio, and reporting. Yeah, these were the roles I was talking about. So under each role, these are the exercise we do in treasury. So based on this only we design our roles in treasury. So this is very specific. Trading, we create deal in this expiration or like whatever changes we are doing at contract stage, this will come under trading only. Apart from contract or apart from before settlement, whatever we do come under trading. So in normal language, once this is settled or review at the time of settlement or reversal or whatever we are doing, it is part of back office. And release, that means once it is settled, and after that whatever we are doing, that is part of accounting, because nothing is left. Once it is settled, we post for accounting, payment, reversal of payment. Sorry, reversal of accounting, and this is only reversal of contract status, because once it is deal is contracted, right? Contract settled. If you face any issue or something like you have given a wrong interest rate or start or end date was wrong, you can still reverse it from contract settlement status to contract status. But once it is settled and post to accounting, that time also you can reverse. So, but that time there will be one more step, because once you are reversing the deal, you need to reverse the flows you have posted to accounting. So there will be 2 steps into it. So that is part of accounting role. So as I said, this can be restricted based on user authorization management, like this is security. So we can create 3 roles. Under each role, we can create these transactions. So money market in detail. Money market transactions are used for short-term investment and borrowing liquid funds. As I said, like interest rate instruments, we are giving loan, we are taking loan, something like that. And money market area is subcomponent of treasury transaction manager and closely integrated with other components. So it is linked with everything, like accounting, and it is linked with other like if you want to have a guarantee, like for example, Like when we take loan, we could normally mortgage something. So that can be done as well in fixed term deposits. So we can create a guarantee. Under that, we can give a limit. So this is a maximum limit. Under that only we can give loan. So that can be done as well. You can implement cash management decision in money market based on liquidity surplus, deficit, data cash management. So this is kind of you can read it. And if you have any question, you can just let me know. This integrated simplifies the work process involved in transaction management and this is already explained. In Treasury, business partner plays a very important role. Okay, so once you create a business partner, and if that is not having complete information in it, it will be difficult for you to create a deal using that business partner. Okay, so under business partner, you have to do following settings or maintenance, I would say. If you miss any of them, then there will be issues. So first of all, role counterparty is mandatory. Then bank details. Sorry, if you don't have bank details, you will not be able to generate TBB1 or payment request. So that is one thing. Bank detail is mandatory. Then you have standing instructions. Sorry, authorizations. Authorizations means this business partner is authorized to create money market or FX. If you don't authorize that, then you will not be able to use that for any money market product. So that business partner should be authorized. And then you need to give, for example, when you create a vendor, you give a beneficiary detail, right? And then you can even enter house bank detail as well, which bank will pay. So using that only business partner will be created. So this bank detail will have both beneficiary and house bank. So this house bank, so one business partner can be used for multiple currencies, right? Because it's not like we can pay off one vendor with one currency. You can pay like vendor with multiple currencies based on the invoices we generate. So this business partner can be used for GBP, Euro, USD, CZ, INR, something like that. So based on these currency, you need to enter all the banking information like house banks for GBP, Euro, USD, and that will be here in house bank details. Okay, so if you don't maintain any combination, and you, for example, euro is missing, right? And then you create a product in euro, a deal in euro, then you will have a missing banking information issue at the time of TBB1. You will get a message as well when you post that deal. When you create a deal, you will give a warning message that banking information is missing. So everything will be derived from business partner. So if that is having complete information maintained, then you will see that business partner is having euro banking information coming from business partner master data to a deal. You will see that. But if you don't have that maintenance, then it will be blank. So you will get that issue. So that has to be fully maintained. Then correspondence. That means like when you create a deal. So in case of FX, okay, so we have MT101 and MT300 files generated, because that is like we send outside, because we have different channels, 360T or something, which will give us the rates and all at different level. Because in normal business process, we get FX rate file coming from outside, and FX deals are created automatically using 360T or Bloomberg. So on daily basis, we receive file from 360T, like this is the FX transaction and this is the negotiable rate, and based on the file received, the system will create FX deals automatically. So this is the normal behavior. But if we don't have that automation in place, we get the rates. So based on that, we generate the files and it will go, we need to upload on FX portals like 360T or Bloomberg, system will generate that. So in case of that, we need to enter correspondence details in the business partner. Once we enter that, it will generate file when we create a deal that we can see. So that is also mandatory. If you don't have this maintenance, then you will not be able to generate that file. So this is a business partner. So this is what I have, basic settings, business partner, transaction authorization. This is where you will authorize your business partner to do money market or FX. Payment details, that is your beneficiary and pay bank, which will pay off. Then you have correspondence, which will help you to generate MT101 and MT300 file. Currencies, this is linked with this payment details. So you need to enter currencies at both times, beneficiary and this one. Okay, so any questions on this one? And this is very important because if you miss this, then you will face issues. So this has to be checked thoroughly. And this is very important at the time of even cutover as well. Because when you are creating your business partners, if you are missing anything, then it will give you trouble. So you need to align your cutover data accordingly. Yeah, so for money market transactions, only the business partners setting in the role counterparty are required. So as I said, so business partner will be created by default in general role. Okay, so without general role, you cannot create a counterparty role for sure. So first you will create a business partner in general role, then you need to extend it to counterparty. And counterparty can be used in multiple company code. For example, you create a business partner in the company code 1. Then you can extend the same role to multiple company codes as well. But this house bank and that has to be aligned with all the company codes only. It cannot be rollover. It is not possible that the same person create or change or release the first partner. So that is like optional, but it is based on your company process. So if you want to have some sort of authorization or restrictions that ones who create the business partner cannot release that business partner. So that is possible. That is using your security roles, and we can have that configuration as well. Based on this master data setting, a new offer contract could be created in SAP Transaction Manager and checked via settlement functionality by the same person or the second person. When the contract is settled, a correspondence is created automatically. So this correspondence means the MT100 and MT300 file. It will be sent directly to the bank to get the counter confirmation. This is what I was saying. Only all release cash flow could be posted to TBB1, only release, that means settled. Okay. If a payment request is created, the treasury payment run F111 is carried out. So payment request is created, that is for outgoing. At the end of treasury payment run, a payment file is created automatically and sent to bank communication manager. So if you have BCM module in place, once you create your payment file using F111, you will see that in BCM monitor, BNK Money. Okay. Once you see that, you can authorize for payment and it will create a batch. Then it will go in your BNK Money. You will see that this is coming and what is the status. First it will show sent, then it will show accepted. So if there are any errors, you can see that as well. So it is a complete chain. If you have, that is why we say like all these are integrated together. So once TRM is over, you will see that in BCM. Bank Communication Manager checks the bank statement. For example, SWIFT is imported and posted with the business transaction code and the reference information in the bank account statement. Find the correct position and so this is how you design your same as OT83, your bank statement. So you need to create all your posting rules and BTC codes. So it is all in BCM. So this is the process which this is a standard process. So normally we don't do all these steps. The steps which I have already explained, like this is part of month end. So this is the complete flow. You can check that. Bank check the conditions, for example, interest rate, maturity and sendbacks counter information, which is automatically matched to the contract. After finishing the external checks, all relevant contract settings for payment details, addresses are checked internally by a second person if all settings are correct. So this is how, like, this is only for FX, okay? Because normally we send MT100 or 300 file is sent for FS only, 60A and 60B, because when we sell or buy FX, okay, forex, foreign currency, then only we'll send this file. For loans, this is not applicable. So this is architecture. So general information, product type, transaction type, business partner, this is the initial screen. Then you have currencies and balance sheet account. Balance sheet accounts is like selected automatically, so you don't need to enter at the time of deal. And the currency is also picked based on your company code currency, but you can change if you are posting in a foreign currency. History, traders and term like start date, end date. Then you have transaction flow, valuation flow, accrual, deferral. This is basically coming from your conditions and your configuration. Prerequisites, I already explained, like create your business partner, assign the corresponding roles to these partners and maintain the transaction authorizations. Set up the standing instructions and release the business partner. Define the product types, transaction types, position management procedure, assignment. So this is like a configuration which you need to do. It is not a complete steps. There are many steps apart from this, but this is the kind of main configuration steps which we need to do. Flow types, you must assign the flow types to transaction types and conditions, like you're doing final repayment or how you're doing monthly or daily, something like that.
Oh, so the main function that of the Treasury, SAP Treasury, is a B2B function, B2B that application. It means you should not map a direct individual except under the exception condition only. So suppose for an example, you have some security in your security issuer, okay, and your security has been subscribed by hundreds of thousands of people. So you should not map those hundreds of thousands of people in a SAP Treasury. Rather, you should be mapping to the security account or the exchange only. So it's not a B2C, it's a B2B software, B2B application. And as a Treasury is integrated with this is all the overview of the SAP Treasury, and where we have this market data management, and we have one risk management and the transaction manager. The transaction manager basically deals with our different submodules within SAP Treasury, that is the money market, loans, forex, derivatives, and securities. And we have the hedge management on the line that is linked with the forex, and that SAP Treasury is deeply linked with SAP FI, because every transaction that being posted from SAP Treasury will go into the FI, and this is the primary, the most deep and the primary integration with SAP Treasury with FI. And apart from this, we can have this SAP Treasury linked with cash management, and in-house cash, and bank BCM, etc. Okay. So likewise, in the core components of the Treasury, we have the business partner, that a person, organization, a group of person who is doing a business with you, with your entity, that is called a business partner here. And then we'll go to the basic functions of the SAP Treasury, and a transaction manager, where all the transaction happens, like front office, middle office, back office, accounting, reporting, and risk management. Okay. And another three, that is market risk, credit risk, and portfolio analyzer, all are the part of the risk management here. Okay. So I can divide into three. The first is master data, that is BP, business partner master data, and the basic function. And the basic function, we have the again master data, like forex data on the interest rates, and this business partner also comes as a master data. So, and second part is transaction manager, where we'll do the actual transactions, perform the actual transactions through the various submodules like money market, forex, or derivative. And the third one is risk analysis, and that is risk management, part of this market, credit, and portfolio risk. So in transaction manager, so we manage all the financial transactions and positions, and support the trading and back office functions, to the monitor and check the releasing. Where releasing means here, if it is assigned, if it is defined in the system, how a transaction will behave. If without any release management, or we should release it, that means someone will create a transaction, and another person, senior colleague or peer, will review and release this. And then transfer of financial accounting, it means whatever a deal created in the system, at later point of time, we have to account it based on the nature of the transaction, nature of the deal. It's a money market deal or security or forex deal. So we'll do the accounting, and it will transfer the financial accounting from Treasury to the financial FI through the integration within TRM and FI. And we can have that flexible configuration for company body specific and manage the position management processes also. And we can assign the portfolios or the transaction management and securities accounts. So here the portfolio means a set of same nature of the transaction. Suppose we are investing, we are a company who invest, we take the money, we invest the market. So how I can manage the investment with the portfolio, like investment in it depends on how we categorize our investments, like based on the industry, based on the terms, based on the type, like a short term, long term, mid term, or like a IT portfolio or manufacturing portfolio, BFSI portfolio, so that we can analysis on the based on the portfolio, we can do that analysis of whether it is profitable of the particular portfolio is profitable or not. And portfolio also play a very important role in SAP Treasury. We can derive that our account assignment or accounting can be derived based on the portfolio. It is linked. We can write a derivation logic that will derive that account assignment, and based on the account assignment will derive that accounting, actually the final accounting in SAP Treasury, and it will post into the SAP file. So the transaction manager we have discussed this consists of the sub-module, various sub-modules of the SAP Treasury, and it deals with the various functions of the SAP Treasury, and like normal Treasury office, front, back, and middle office. These are the components of the SAP Treasury Transaction Manager, and widely divided into the money market, forex, loans. Loans basically part of this money market only, okay, and derivatives, securities, and commodities. So, any question till now based on these sub-modules of the SAP Treasury? So this is the overview of the transaction and the position management processes. And it says that transaction and position management processes is split into two areas. So the two areas is trading area, and where you create the transaction and exercise the rights. And in back office, you settle the transaction and you check that, if the transaction is correct, if something needs to be changed, then you can correct it in the back office area. Okay. Even it depends on that level of the organization. Somewhere there is a single person who can manage all. Somewhere you are following multi-layer of the approval, multi-level of the checking of the particular transaction. And in basic only three or four areas. If you have well-structured treasury department in a company, like front office, back office, and accounting and reporting. So this accounting covers the accounting treatment related to the deals, and it transfers the position information to the FI general ledger to the accounting entries. And we can see within treasury, we can see this with sub-ledger, sub-ledger reporting. Overview of the process, how it go through once at the trading area, at the front office, we need to create. We are creating a deal. We can create a deal. We should exercise rights, and we can terminate or roll over something if it is required. And at back office, we are settling and checking. We are adjusting the interest rate, netting and referencing, and we are taking the corporate actions, and some, if it requires, transfer the securities account and letter of confirmation. It means correspondence also taken care at the back office level. And after the back office, the transaction is going to release, and then it will ready for the account posting. And once the transaction posting, the T codes, the relevant T code will be executed, it will post the accounting. Accounting means the general accounting or any payment, any reversal, accrual, deferral, valuation, all that actual accounting will happen at later point of time. That is accounting department will take care. So this is the overview of the money market. In money market, basically we are dealing all the OTC products. this over the counter, that is not being traded, that is not being routed through the exchange. We can go directly to the bank, we can ask for a FD, we can ask for a loan, or any other product that is directly over the counter you can purchase or you can sell something. That is covered in the money market. So basically, I should say that money market transactions are used for the short-term to medium-term investment and borrowing liquid funds. So short-term and medium-term investment, the plan here in the money market, and with the transaction we can borrow or we can invest in in the money market for the short-term to medium terms. And it is in money market is integrated with the transaction manager. That's another component of the SAP Treasury. It is closely integrated with the transaction manager because all the transactions happen that sits within transaction manager, or the actions taken from the transaction manager only. And if the cash management implemented, so the money market is also integrated with the cash management, where we need to decide if we have this fund surplus or deficit based on the cash management. Then we need to decide whether we are coming, rolling a week, coming 15 days or a month, what we need to do. Based on the cash management, we can decide whether we are going to have a surplus fund or a deficit that is required. If the fund surplus, we can invest somewhere. If the funds are it's not surplus, it's deficit, we should decide if we want a quick loan, a quick borrow from over the night borrow, long term, short term, medium term borrow. So based on this integration, we need to decide, we should take the decision. It's also linked with the financial accounting and other data that is relevant for posting money market or automatically transferred to the FI, that we know. And the basic features of the money market trading area that contains the market transaction and enables you to set the information from the transactions. You can change it, and you can do the collective processing. Collective processing means different. Suppose you have 10 transactions in your money market. Then under the collective process, whatever the status of their deals, you can call all the deals at once within a period of time, or as per the transaction number or transaction range, and whatever the status of those, you can process at once. What are the master data that is on the basic setting of the money market? So under the money market, we have this business partner. Business partner is the primary component of the SAP Treasury. Without business partner, we cannot start actually. So business partner management, transaction authorization, payments, correspondence, and activities. So these all comes under this money market management. So I'm saying that money market transaction, only the business partner setting, the sole counterparty are required. So a business partner can have multiple roles. Suppose me as a Suresh, I'm a business partner. Suppose, okay. So I'm dealing with multiple entities. So for the bank, I am a customer for the bank, and I am a trainer for the company. I'm an employee of the company. So these are different roles for a single person can have, person or entity can have. So counterpartner means a party, a business partner you are dealing with. Suppose for you, bank is your counterparty, and for bank you are the counterparty. Okay. So before you can use this business partner, release is required. Okay. If it is assigned like that, a business partner needs to be released, then any change, any new creation of the BP, any change is made, it will trigger a release management, and once it's released, then it is possible to, you can create, and you can use the business partner later point of time. And correspondence setting also based on the business partner. So here the correspondence setting means, if you have correspondence configured, assigned in the system, then you need to assign those correspondence. If it is internal correspondence, external correspondence, you need to assign to your business partner. And once, at any point of time, if some deals are happening and transactions being created, it will trigger an automatic correspondence generation. So this is the money market, typical money market process. Starting with BP and end with the settlement or the posting. So once BP is created and workflow generated, it was released, you can create an offer. From offer, you can create a contract. Here, generally, I have not seen that in real-time companies are creating offers. They directly go with contract only. Offer means you have suppose you are seeking for a loan, looking for a loan from multiple vendors, multiple banks. You have ICICI, DFC, IDBI. They have provided for a same loan, for a same period, for the same type of loan, different rate. So a front office guy who is dealing with the bank, they can create offer from IDBI, offer from ICICI or HDFC, IDBI, whatsoever. They can create offer. The best offer, you can pick the best offer and you can go with the contract, final contract with them. But in general practice, I have not seen a company doing offer and contract. Directly they will go with contract. Once you have the contract in place, you should settle, you should then post that, that it will, for monthly, each month, if the transaction is not your currency, then you should go for valuation, MPV or market risk analysis. So anything, if the valuation should happen for any forex and assets only. Asset only if you have stocks in invested in stocks, or you have some transactions that is not your in company, that is not your home local currency. If the foreign currency transaction you have, you should definitely go for the valuation one, like that's called M2M, mark to market. And monthly also you you doing the interest accrual. For suppose there is a deal that is that lasts for 1 year, and interest accrued for 12,000. So you need to accrue monthly 1 month, 1,000 each month. And it depends on the requirement of accounting standard and requirement of the company. If they are going for the simple accrual, differentiation method, or they are going for the reset method also. Reset method, each month they will accumulate the interest and reset, reverse the next day, very next day. Suppose this deal is starting from 1st April 21 till till 31st March 22. So deal this interest portion is 12,000. That means every 1 month we need to transfer the interest expense to that P&L account. So in our reset methods, what they are doing, what you should do, you are accumulating this month interest, you will post, and very next day you will reverse. Then next month you have to accrue for 2 months, because last month you have reversed. You should be accruing for 2 months, and then you are reversing the next day. And in differentiation method, it will not happen. It will not accrue anything. It simply post the portion of that relevant days for the month. It will post direct into the accounting, this expense account. And interest rate adjustment also happen. So there are various methods, various types, how we can adjust the interest rates. There are a lot of, I know that 3 methods are there, or more than that also. But in practice, we choose to have these 2 or 3 methods. So the one method that is called relevant to the posting. It means, so why basically we use the interest rate adjustment? So basically it should be used as and when required. If an interest getting changed, then you should adjust it. That's my opinion. That's my thought for the interest rate adjustment. But I have seen people are doing it monthly. Monthly means even if the interest is not getting changed, they're adjusting the interest. But in my opinion, you should adjust your interest whenever it changes. The change may have at spread level or the basic also. Suppose for an Indian client you're working, and it's Then here is MCLR, marginal cost of lending rate plus spread. Base rate plus spread. Base is MCLR here. So as per agreement, base generally not change within a span of time. It's a 1 month, 6 months, 3 months, a year. So you have suppose MCLR 6 months. So this MCLR is not going to change within before 6 months. That is fixed. That is base rate is fixed. And spread. So this spread could be changed based on your relationship with banks. If you are paying well, you are relationship good with bank, then you can ask, you can demand from the bank to change the spread, and bank can take the decision. In that case, you should be adjusting your interest rate. It means you are changing that interest condition, and you should be creating a new condition, and you should change your spread, and then you should adjust your interest rate. Generally, I follow like that, but yeah, many companies they follow the monthly interest adjustment. Even the monthly adjustment is not happening because that is relatively that's a smooth option actually. Basically, you need not to check whenever it is changing. You are adjusting the month and monthly, so it will be taken care. Now, once that deal is created and it is settled, now it's going to settle. Okay, once it is settled, it will generate the correspondence, and it is ready for the account posting, and within accounting posting, if it is asked for that it is required, we can generate the payment request. Then it will go to the payment request will be processed further with the F111. That is Treasury. It's the same like a F110 in the SAP Treasury.
All right, let's test your knowledge. Here's a question for you. Which of the following is not a key feature of SAP FSCM TRM on ECC ERP Central Component? Option A, cash flow forecasting. Option B, liquidity planning. Option C, commodity risk management. Option D, sales order management. Take a moment to think, and when you're ready, choose the correct option. Remember, each choice holds a key to unlocking the answer. Good luck! Type the correct answer in the comment section. Hey there! Looking to master SAP FSCM TRM on ECC? Our course has got you covered. Take it at your own pace on our platform. In this course, you'll dive into SAP FSCM TRM on ECC, your go-to tool for managing supplies efficiently. From ensuring we have enough products to getting them where they need to go, we've got it all covered. Our course is comprehensive, covering everything from the basics to advanced strategies. Crafted by seasoned experts, you're in good hands. Your instructors are pros with years of experience. They're here to guide you through and answer any questions you may have. And guess what? Our students rave about the course. Folks just like you have found it incredibly helpful. The best part? It's budget-friendly, so you can learn without breaking the bank. Ready to level up your SAP FSCM TRM on ECC skills? Sign up on our page now. For more info, head to ZaranTech's website.
If the payment request will be anything apart from this vendor customer, we are processing the direct GL processing from the F111, and then it will go to the bank, and the final one, the bank statement will come. So that's all the money market process over here. Any question here? Because money market process is different from securities process. I have not worked the vendor master integration directly in the SAP Treasury, because I have worked in S4 for customer master. I mean, customer master means suppose you have a requirement to link your BP with customer. Generally, that point comes whenever you have, suppose you have taken a loan, 100 crores of loan, okay, and you have intermediate, a broker there, okay. So broker, through the broker you have taken these services, So broker will raise that an invoice. And as per FI, as per general, I'm not talking SAP FI, in general business practices, someone raising you to invoice, here's your, you have purchased something, here's your vendor, your, okay, supplier. So in SAP, you will be creating a vendor, but as suggested by SAP, as I know, SAP vendors should not integrate with SAP Treasury, rather customers should. That's what I'm saying. As I have seen and I have gone through the SAP documents, it is not suggested that we should integrate the vendor. Maybe the technical reason, something technical reason from SAP that I don't know actually. Yeah, so one thing I'll let you know. Suppose for an example, you have a vendor, you have taken a loan from, no, not loan, so purchased something, okay, you purchased some services from XY ABC company. So in SAP FI, before coming to the treasury, you will go in SAP FI, correct? So what you will create? You will create a business partner as a role of vendor. I mean, anyone is a business partner for you. Suppose I'm providing training to you. Suppose a direct training, I mean providing a training to you. I'm a business partner. You are dealing with bank is business partner. You are providing consulting to XYZ company. That company is a business partner. So basically, based on that situation, the role of business partner may change. For you, it's a vendor, but the same business partner in treasury, it is called as a counterparty if treasury department have taken some services from them. Okay, and same way, I'll take another example. You are selling to someone, you have a customer, but any point of time, maybe there is a situation that customer becomes the vendor, they will supply something to you. So in that case, the same business partner, ABC Limited, is having vendor and customer both the roles. So in SAP, in HANA and SAP Treasury, before HANA also, in SAP Treasury, there is a business partner concept. So now SAP has integrated or extended their business partner functionality so that we should create a business partner in different role. So generally talks about that all related cash flow could be posted by a TBB1. It means the TBB1 is the first transaction in money market. Suppose you have created a transaction, a deal, a loan. Okay, you have taken a loan from HDFC. So you have created a transaction in SAP Treasury. Creating a transaction itself will not post anything. It is just an information. That's information of what is the term condition, I mean start of the deal, end of the deal, I mean interest of the start of the contract, end of the contract date, and the interest rate, their percentage, and the mode of payment. It will be monthly, quarterly, half yearly, yearly, and if you have the deferred payment, you have deferred disbursement, any condition related to your contract, this borrowing or investment contract, you should enter, you should frame in the deal, you should frame in the transaction level. And once you saved it, once it is settled, so once you save it, it means the transactions are ready for review. A senior to you, of your peer or someone who is assigned as a role who can review your deal, so that person can review. If all the information are okay, provided, agreed, that your senior can settle. I mean, settle, and it can be approved and released there. Okay. Once it is released, it means that your contract is approved from your senior or someone. Then you can do the first accounting transaction. Suppose in that case you have taken a loan from bank, then it will be your then you can post the accounting entry here. So your bank account will be debited and your the loans account will be credited here. So that will be the first entry you can post to the TBB1. And once the first entry posted, if it is in your local currency, there is no valuation. If it is in foreign currency, monthly we should start with mark-to-market process. And another thing, if based on the deal term, suppose it's a 1 month loan. Hypothetically, I'm talking, it's 1 month loan. So you should not be doing any valuation, any accrual or deferral. because it's 1 month, within 1 month it will be finished. If it is not falling it's not crossing another month. Suppose you have taken a loan on 15th of the 14th or 15th of the April, and it will last in May for 1 month, but on 30th of the April you should do the valuation and accrual also. Generally, we should not recommend for any automatics means system will not going to trigger automatic first. You should make some arrangement using the SAP tool itself, like creating a job, or you are using a third party that will also create or manage your job. You should create a job by yourself, SAP, within SAP, or you are using some external tool that will enter into SAP and create a job and manage the transaction run based on your certain parameters. But we should not do it automatically. There is a risk, but you can manage, you can mitigate the risk, but it is not suggestible, it is not advisable. Because I have worked where thousands of posting happening, but we are doing it manually over the month end process. We are taking 3-4 days to adjust the month end process, but we should do it manually because there should be some process and it will get failed. So SAP, when you are doing a valuation run, you will not you won't be able to see like it's which accounting principle. So accounting principle assigned to a valuation method, valuation area, that is called accounting principle. Okay, suppose you have valuation area 1, valuation area 2. Valuation area 1 means US or IFRS. Valuation area 2 we represent at Indian GAAP, IGAP. So we can assign based on this different valuation area. We can assign different accounting principle, and definitely it will behave like that. As per that, how you define it, how you customize it, how you configure it, it will behave. It will provide the output like that. You can post. In the nutshell, you can post from a single transaction. You can post 2 different type of valuation for the different valuation area. Accruals. So can we do, apart from SAP also, can we do a deferral, and what should be that condition? Why we should do deferral? Accrual is one thing. There is a term also called deferral. So can someone from accounting background who is having experience can tell me why we should do the deferral also if required, and what was the condition when we should do the deferrals? Why we are doing the accruals monthly. But there is a condition, there is some time we should do deferral also. So what could be the reason for deferral? Apart from SAP also, SAP is able to manage the deferral, but in general terms, if you are an accounting guy, you are doing deferral, so what should be the reason to do the deferral? The provision terminology means you don't have any exact idea, you don't have invoice. Suppose provision, let me explain the provision here. You are getting each month the electricity bill, okay, and you know that it comes from a range from 1 lakh and 1 lakh 10,000, 20,000 something. But for the month of March, you didn't receive the bills from the electricity department because they are always late. But you are near to close the period account, this month-end process and year-end process. Then what you should do? You should be doing the provisions because you don't have the actual invoices. If you are receiving something in advance, it means it's liability to you. And if you are giving someone advance, it means asset to you. So if you are giving someone advance or you paid some for the services advance, the services will be rendered in future, or you are paid at upfront fee, but this upfront fee will be utilized over the span over the period of the deal. A loan is taken, brokerage fees paid today, but it's relatively, suppose the loan is for 3 years. It means we should consume this, we should account this brokerage fee over the span of 3 years because it relates to the 3 years, correct? So if you're paying the upfront fee, then upfront fee we should not, it also depends further, this condition is, it depends on your internal account policy, that disclosure of the policy at this per accounting practice, your internal accounting policy, your gap. Suppose your internal policy says that we should not defer it if it is under 10,000, 50,000, 1 lakh. Depends on the organization, scale of the transaction. But IFRS says if you paid someone advance, it is more than 20,000, you should defer it. Correct? It be based on the accounting, rules, accounting policy. So suppose it comes under your policy, you paid someone 36,000. I'm just taking the simple example for three years. So you're paying upfront 36,000. So this payment should not be accounted as an expense. It should be an asset to you, and first it will be accounted, it will be shown in the balance sheet, and over the period, gradually, month on month, it defer. Because we have deferred, we have not accounted in expenses, it means we have deferred it. So we should defer it from this balance sheet. Gradually, it will move to the P&L over the period of time. As we know in the accounting practice, like advance payment, and any advertisement expenses, basically that we do the advertisement expense, pay that advertisement fee upfront, and we are utilizing, we assume that this should be utilized within 2 years, 3 years. So in the deferral will come in that case. It's very important here. It's architecture of the total financial transaction. It means the overall, the above body is the product type. Product type could be in SAP, the product type, SAP Treasury, the product type is provided, inbuilt. Inbuilt means the fixed term deposit, which means 51A. Commercial paper, the product type is 53A. These are the codes of the product types. But based on your requirement, based on that accounting, if it matches the similar way, we can use the same product type that is provided in SAP. Generally, we should not create all product type. Rather, exception is, rather we should copy an existing product type. Because if you create your own product type without copying, you may make some mistake. You may do some mistake. So then at later point of time, you will be in trouble. So we should copy. Suppose, for example, there is a fixed deposit. That is 51A, product type 51A. And you have some similar kind of, suppose intercompany deposit, intercorporate deposit, okay, ICD. So then you will look into the SAP Treasury. There is no intercorporate deposit product type is available. But then you start thinking that, okay, this fixed deposit and intercorporate deposit, both are similar in nature. Suppose both are similar in nature. Then you should copy the fixed deposit product type and you should just rename it intercorporate deposit. Understand it? And this likewise happening in the money market, this interest rate instrument also, that is called 55A. You have various kind of loan, short-term loan, long-term loan, or if you are categorizing your loan based on your financial industry type, loan from bank, loan from government, loan from NBFC, then you are having, you can use the same product type, copy them, make it another product type, copy them. Okay. So product type, then transaction type decide whether it's an investment, whether it's a borrowing, or these the product type, transaction type, business partner. These are available across the module, across sub-module of SAP Treasury. But their purpose, their mode of action may differ. Suppose in money market, the transaction type should be borrowing or investment. But in security, there is no borrowing or there is no borrowing here. Either you are investing or you are issuing a security, or you are investing into the security, correct? So transaction type may be, there will be different transaction type available. Then I mean, under the conditions, we should describe that, what the interest condition is, what the repayment condition, and in general info of the transaction, we should see that currency, that the balance sheet account. This balance sheet account differs actually, I mean, it's related to the account assignment reference, and we can see the history of our trades and history of the terms. It will the further, I mean, followed by the transfer flow, valuation flow, accrual, deferral. So this is the typical overview of this financial transaction, architecture of the financial transactions. Yeah, so rather I'm using the technical word, let me say, what is the product type? Product type means it's instrument. I think you can relate, it's instrument, in financial instrument. So what financial instrument could be? It's FP is a financial instrument, correct? Loan is a financial instrument. Futures, yep. Options, forward, spot, all these are, we could say it's financial instruments. So financial instruments are referred as a product type in SAP Treasury. You are a BFSI, you are NBFC, you are a non-banking financial corporation. So in that case, you can, if there will be condition, either you borrow or you invest somewhere. It means invest means you borrow or you lend. Okay. So these are the transaction type. So the product type will be the loan, short-term loan or long-term loan. The loan is a product type, loan. Now, the transaction could be either lending or borrowing. You are giving loan to someone, it will be called as L&D transaction type. You are borrowing, BOR, I mean you are borrowing. So it's a further differentiation between your transaction actually happening. There are limits, product type, I'm going to detail in. So product type further backend by the product categories. Product category means that is the limit. You cannot go beyond the product limits. So product limit says, suppose product limit is 510 product limit. So the 510 product category will say anything that you are dealing with money market, you should not cross the limit of the feature of 510. So 510 means then there will be under 510 product category, there will be a standard product type 551A, 51B, 52A, 52B. So you can create your product type as much as you can. You can modify, you can, generally we do not recommend to modify an existing product type. You should create your own, copying the existing product type, inbuilt provided by the SAP. Okay. So your limitation is the product category. You cannot go beyond. What product category limits? It limits the market, the area. Area means loan, money market, securities, derivatives. These are basically defined within SAP as somewhere as a product categories. Category means, suppose as of now, today, there is letter of credit, trade finance. We have the trade finance module in SAP Treasury. But earlier, 5 years back or 10 years back, there was no product category trade finance available in the SAP Treasury. Then, by that time, you cannot create by any way, by any mean, you were not able to create a trade finance in like letter of credit or bank guarantee in SAP Treasury. Because the product category was not available, trade finance was not available. You got to understand? So your limit is the product category. Product type you can copy and paste. You can modify as per your requirement. But you cannot go beyond the product category. Product category is the segment, the area SAP provided. You cannot go beyond that. So here it's again talking about what are the product types available in the money market. So fixed term deposit, deposit notice, interest instrument, cash flow transaction facilities. So these are the product types. If your requirement matching with this product type further backend by product category. So under product category 510, this all 5 product types are falling. And if your any kind of requirement or matching with these product types, you can copy and create your own product type. Okay, so it's talking about how we define the money market in product type. So it's saying that define the product type. If you do not want to use one of the standard product type delivered with the SAP system, okay, then you can define your own product type and you can create a financial transaction, manage position, basis of the product type. IFD is one example of the product type in the money market area, correct. And the transaction type, it's saying the transaction type determines the types of the transaction that can be concluded with the particular product type. That I've given an example of this borrowing and lending. Both are the loan, but loan what? You have borrowed loan or you given the loan, you lend the loan. Likewise, in the intercorporate deposit. Intercorporate deposit, you may have taken the intercorporate deposit from your sister concern, or you have deposited something in your sister concern. So borrow or investment, what you did. So under the product type ICD, you can have different transaction types. And they also control the transaction position management processes. And for an example, investment of or borrowing of the fixed term deposit. And yeah, it's also important the flow type. So once you have the product type in the system, you have the then you should be defining a flow type. Flow type is also available standard. Generally, we should not modify the existing. If you require, you can copy it. You can make it. The flow type basically define the flows of the cash flow. Actually, basically, flow type here means cash flow. What you see. Once you create a deal, you will be able to see a cash flow of that future cash flow. So those cash flow, particular flow cash flows are each flow line item is a based upon your flow type configuration actually. Example here, increase in the nominal amount. It means product type, then transaction type further assigned to a flow type, and there will be an update type. Okay, that update will happen when you post accounting from Treasury to finance. And the condition type is very important, and this is for the condition could be either in two terms. So interest condition or payment condition. Suppose you've taken a loan from bank. So what is the condition? Condition means the condition of interest payment. I mean, you are going to pay monthly, daily, weekly, how you pay and when you pay. That is interest condition. And another is repayment. When you pay the principal, I mean, it's bullet payment, some ad hoc payment, some EMI you are providing, or there is a deferment of payment. Those repayment conditions called as condition types that should map here. Sorry. Yeah, so flow type will automatically assigned in the configuration level. It is automatically assigned. So let me visualize it like so. If you are investing, if you are taking a loan, okay. So you have taken the product type as some long-term loan, okay. Then transaction type is borrow. Then you have selected the business partner. Now this will automatically come as a borrowing increase. Borrowing increase is the one flow type. Borrowing increase. And when you are paying something, there is a scheduled payment, it will be decrease, borrowing decrease. I mean, decrease in the nominal amount. Basically, something, if you are increasing your borrowing, it will be increase in the nominal amount. You are paying back, you are repaying your principal amount, it will be said as decrease in nominal amount. And interest will be said the nominal interest portion. The interest will be denoted as a flow type. In the flow type, it's a nominal interest. Suppose it's and there will be a code also 1200 1201. This is the code, and the name is the nominal interest. The interest will be paid in future. So the flow at the cash flow tab, you can see increase in amount, decrease in nominal amount, interest payment, final payment. Then at the time of the maturity, there will be a final payment. You can define, you can copy, you can define your new based on your requirement. And flow types are controlled by the flow categories. Flow categories are a SAP standard. You cannot go beyond that flow category. Just like a product type, product category, flow type, flow category, condition type, condition category. So what is the category basically here? Flow category means accruals, deferral, valuation, and fixed payment, other flows. So it means they have some nature of the flow type. Category means the nature of the flow type. So within the nature, within the category, you can define your own flow type based on your requirement. So flow type will not create a GL entry. Flow type is your position management. You can see the reports based on the flow types. I mean, what is your position is that you can show. You can see the based on your flow type, because this is assigned. You can see in the cash flow tab, and this flow type is the position flow. Basically, it's a reporting purpose. But the accounting is happen at the update type level. There is a further another type of this, there is another configuration that is called update type. So update type is huge. There is the difference between flow type and update type is flow type is for our position and cash flow purpose, and update type is for a real accounting purpose. So update type will lead to your accounting, general accounting, GL posting. So the condition could be in two cases. In the money market, the condition means the condition of your contract. Condition could be on the two terms: interest condition, interest payment condition, or the repayment condition, the principal payment condition. Suppose you have taken a loan, now you have to pay the loan. You can bifurcate the loan. You are monthly, you have to pay the interest. Okay, and at certain point of time, either on maturity or quarterly, monthly, something, you need to repay the principal also, correct? So there could be a condition for two things: how you pay the interest, how you repay your principal. So condition type will be assigned to the two things: repayment condition and interest payment condition. Condition types are more than two, but yeah, here in general I'm talking about this money market. This could be interest payment condition or principal payment condition. Why these are called a condition? Because you have the at the business requirement there could be different type of payment. Suppose I'm taking the example of the principal repayment. Your loan is starting from 1st of April, but you have an agreement with your bank that you will repay your principal. The first principal repayment will start from 22 or 23. I mean, you have moratorium period in between, 2 years of moratorium period. Okay, so it means you have a condition of the repayment. So this condition type will assign to this. There should be condition type assigned. Then you can create a condition in SAP, the repayment condition. Okay, and now coming to the interest. So interest, as per the agreement with your bank, you may pay it quarterly or monthly. I don't think it's go beyond quarterly generally. Monthly and quarterly we are paying in Indian scenario. So those conditions to be defined. I mean, when it's going to due, it's monthly due, month-end due, or month-on-month due, every first it's due. So when it will be the due, when it will be paid. So there will be due and pay. There could be difference between due and payment. Those conditions could be defined here. And later point of time, if there is a change in interest rate, base or spread, you could create a new condition of interest condition for that period. Suppose MCLR 1 year from April 21 till 34 March 22. But from April 22, the MCLR base is reducing from 7.2 to 6.5%. Then this condition should be changed in the SAP. Then you should change the interest condition. So this condition type for this interest, first of all, if you not assign the condition type, you won't be able to take a variable interest loan, floating interest loan. Your system will not allow you. First, this is important, because in a standard, it's a fixed term deposit, fixed term borrow you can do, because the interest type, the borrowing could be in two form, or it's a fixed term or it's a floating variable interest rate. If you want to use the variable interest rate, then you should assign the condition type in a product. Then you will be able to use the condition variable interest rate. So that is a technically important point. And now coming to this, what will be the impact? Once you assign this condition type and you create the condition, you will be able to see the interest rate adjustment then you can adjust your interest rates. Condition type for a commercial paper, I think this condition type, because we don't have the variable interest here, so the condition type should not be there. But for the repayment, I need to look. I need to look because the repayment should be, because the commercial paper can be managed either in money market or in securities also. Commercial type is the nature. If you are OTC, you have the OTC commercial paper, you should manage in money market. You have exchange traded commercial paper, you should manage in security. It's talking about mainly the money market, but I am talking about the overall prerequisite for SAP Treasury. Prerequisite means when you are able to start create a deal, a transaction. So just like in the finance, if you want to create a vendor invoices, so it means a vendor should be already created in the system, correct? Then you can create a vendor invoice, a vendor something related transaction you can do. Likewise in SAP Treasury, if you want to create a deal, so what all are the prerequisites you should have? So first of all, you should be having a business partner. You should be having the company code in place, product type, transaction type, and flow type, update type, condition type. These should be in place as a configuration or master data before you should start a transaction in SAP Treasury. You can differentiate with the transaction type, or even if you're not differentiating, it does not matter. Why it doesn't matter? I tell you. You have a loan, a borrowing you are doing. So it matters whether it's a short term, long term, mid term. This is the matter only for the valuation purpose, correct? Further coming, whether it's fixed interest or variable interest, generally does not matter because there is no, there is no impact on the overall process just because you need to assign the variable interest rate. So you should not go with the type of the interest rate. Otherwise what will happen? You will land up with creating of so many product types or transaction type in the SAP Treasury based on their type of interest rate, based on their maturity, based on their period. Then you could be, you will be creating a lot of product types. Yeah, it's an important question. And now you could relate the condition type here. If you assign your condition type with your product type, then you will be able to see the variable interest rate option in your while you're creating a deal your transaction in SAP Treasury. If you have not assigned, you will not be able to see, you won't be able to see. Okay, so for an example, it was assigned. If it is assigned, then when you start creating a deal, there will be an option fixed, floating, variable, or there is another option, but we are not using that. Only two options we are using it, fixed and variable. So you can select as per your requirement. So that's why I was saying, suppose, so zero coupon bond exactly matches with the commercial paper. So the features in commercial paper you can see in the bond, but it depends on, because the bond is it's not OTC, correct? It's an exchange traded product. If you're talking about the condition type for the bond, so here should be that bond is in terms of the future, it's commercial paper. But if you are issuer of the bond, it means indirectly it means you have taken a loan from someone, correct? Then in that case there should be some condition of the payment, because now coming into the interest condition. Interest condition could be the nature of the loan, a term loan or short term loan, because the frequency will be decided. But you are saying it's a zero coupon bond, so zero coupon is exactly same with the commercial paper nature. But when you are using some percentage bond, 5% bond, there is a coupon rate is there. The coupon rate, then it will, it becomes like a borrowing actually. Then the interest condition should be defined. You must assign the flow type, transaction type, and the condition type, all the same thing. It's saying that the setting can define the condition. The setting controls which structure characteristics are displayed when you create transaction. For an example, it's a nominal interest. So if you define this condition type, the interest will be, you will be able to choose the interest type, variable or fixed. So why we use the interest rate instrument? What are the prerequisites? Product type, flow type, and condition types. Here the cash flow transactions. Generally we are not using. I mean, I have used rarely I use this cash flow transactions. Generally it's if you are not able to, your requirement not fit into this interest rate instrument, then you can use this cash flow transaction. Basically, it provide you the you will see in the coming days. You will see it provide this flexibility to define. I mean, there is no fixed condition. There is no fixed structure. Your structure you should define it by your own everything. So it enables you to represent wide range of transaction flexibility in the money market. You enter the term manually, cash flow results from the particular structure of the transaction. This includes the position, changes, expenses, revenue, and payment. It means there in this cash flow transaction, you have a lot of flexibility to modify or create your transaction by your own nature. But these have some limitations also. So generally, most of the time, our requirement, we are able to match the requirement within an interest rate instrument. So generally, we are not using it, cash flow transaction, because it does not have any structure. If you start creating the cash flow, you see there is no structure. All the structure you have to define by your own. So prerequisite are same for the money market. Okay. So you have to maintain the master data first and assign it, define condition type, huge. Okay. This facility is very important here. In general terms, what are the facility? Can someone? I know that you know the facility. So for this facility could be, and in general terms, it could be a bilateral facility or a syndicated facility. Okay. So can someone just help me with what all the exact facility, what is the facility, and why we take the facility and why we use the facility? The general feature of the facility is only you and your one bank. And once you have a huge requirement, you approach, suppose IDBI bank with 5,000 crore or 500 crore, sorry, not 5,000, too much, 500 crore requirement. Then they need to look, they will say, okay, give your requirement, we'll look into this. Okay. Then they will approach their, they will tie up with other banks, and it will create a consortium a bridge loan, a consortium loan. Then it will be a bilateral syndicated facility for you, because your loans are facilitated by the several banks, and there will be a leading bank, there will be a member bank. Okay. And in syndicate facility, you have one master agreement, but you should be receiving your fund based on your requirement, and there will be it depends on agreement. When you approach to someone, they will automatically disburse you, and when they will disburse, either you should approach them for the disbursement, to whom you should approach, who should be approached first. Suppose in a consortium you have 4 banks, IDBI, ICC, IDFC, IC, and IDFC, okay. So maybe if the IDBI is the lead bank, so he had to provide the loan you first. Once he exhausts, and then the member bank should start providing you. It depends on the agreement. But in our facility, the facility will be created at once, and at facility itself does not create any loan. Got it? I'm repeating it. Creating a facility does not mean creating a loan here. Creating a facility means you are creating a just facility, means it's an agreement that you have taken the facility of the 500 crore and that will be utilized in future. So how you will utilize the facility? 1st of April there is an agreement done that you require a 500 crores facility. and the facility is sanctioned by the IDBI bank, and they have created a consortium and is it sanctioned by them. Now, when you require, now you suppose you require 100 crores in June or July, 1st July. So on the 1st July, and that particular 100 crore is funded by, disbursed by IDBI bank. Then you have to create a deal for 100 crore from IDBI bank, and you need to assign the facility, because you should not go beyond the facility sanction. 500 crore, you should not go beyond that. Once you assign the facility controls that you should not create a transaction, a deal more than 500. That will stop you. Okay. Here, this is just nature of the facility: confirmed facility and unconfirmed facility. Okay, the confirmed facility is letter guarantee the availability of the limited credit amount at any time. Okay, and yes, the borrower had to pay the charge for this, and we can map the charges also. And what is unconfirmed facility? The lender, the bank will not guarantee the credit limit, but there will not be any charges also. Okay, so you can assign FD, a deposit notice, or any cash flow transaction or interest rate instrument to a facility. Generally, we are not assigning a FD, fixed deposit, to a facility. We are assigning only the deal that's borrowing to the facility only. Yeah. So this product type, so if you have the facility to revolving, then we can map the revolving or rollover, whatever. Rollover, so let me explain it. Suppose you have a loan that was expected to be, and at end of the period, before end of the year, one day before end of the period, you and bank, you decided to continue this, you did not to finish, you need not to, end this loan. So you will approach the bank, and bank will be redeeming this loan, and that will be called a rollover, and you should continue with this the present loan, or maybe bank can mature this loan, and they will create a new loan account for you with the same condition. Mature this, and you should create a new loan, and that need to be assigned. If it is with the updated terms of condition, you should assign the facility, and you should create the underlying transaction for this. So it becomes actually it's called a revolving facility. Okay. So under this revolving facility of the loan, suppose in terms of the revolving credit facility, the form of the credit facility that issued by any kind of the bank. Okay, and it depends on the drawing actually. On the drawing, how much you draw and when you draw, and the repayment condition. And the revolving facility, you should be creating the revolving, you should select the revolving facility while you revolving this actually. There is a condition, I'm not able to exactly recall, okay, but there is a revolving nature of the facility available. That is for sure. I could explain in the while we are doing this session. Yeah, so the overview of this money market is over now. Now we are heading to the foreign exchange. So in foreign exchange, what's saying that transaction management functions allow the impact of the forex trading and on the liquidity situation of your company as well as the resulting currency risk. And we should maintain this current market data. So market data is exchange rate data, security price, and the reference interest rate price. And number of ways, we can maintain this market data in multiple ways, like manually, a market data interface, okay, and or by transferring the market data to the system from the Excel sheet or data feed. So small client action that they used to upload the Excel file, or they used to create manually, but the organization, those are on bigger scale, they used to have this Bloomberg, Reuters, FXall, different integration with the other third-party market providers. So the market rate will be updated daily based on the condition will be daily, because between SAP and the market rate provider there will be multiple or several or single interfaces. Suppose for an example, if, from Bloomberg it will come to the EDI, from EDI it will come to TIBCO, TIBCO it will come to the SAP. There is another route, and there is another route we can directly fetch from Bloomberg to SAP. But generally we should not go for direct option, because there is a exposure risk. So in Forex we have the spot transaction, we have this spot, forward, basically, and or here, but okay. Transaction I'll cover at a point of time here, and let me explain this. Customizing means we should know that, I mean, where the file type will come and how it will be pushed into the SAP. Those things we definitely need to customize. But we should, here the point is the interfaces. We should direct take the file from Bloomberg and push it to SAP, or we should be using the different interfaces, a multi-layer of interface, to avoid the exposure, the data exposure risk to the third party. Suppose you have, you are using some kind of tool that will fetch the data from Bloomberg and feed into the SAP. Okay. So it means you are depending on the single particular tool. That leads to the risk. I mean, someone can hack, someone can, hijack your system, and your system is at risk. Okay, but if you're using a multi-layer secured interfaces, so it's good. I mean, it's more secure and reliable. You need to take the help of your IT team, because how it will come, how the data. There are only one thing: how the data will come, what will be the frequency, and where you first store the data, and how you then push to the SAP bank. So, and that I'll try to cover that question, but here we don't have Bloomberg, we don't have Bloomberg integration in training session. Okay, so I'll show you the file process and how the files should be uploaded into the SAP. So, in foreign exchange, it is not possible to create an offer, but when the spot rate, swap rate, for example, is unknown, the process chain could start with orders. Generally, we should not, generally in SAP Treasury, we are not going through the offer. So now this is the typical FX process. We should have this BP created, and based on the BP workflow, it's released, then we should create a contract. Okay, and contract should be settled. And if there is this bond or something interest related, then we should do the interest accrual. Or it's a simple forex, we should do the valuation, NPV, and market risk analyzer we should do. And the once settled, deal is settled, it will create a correspondence, and it will send to the bank, and EBS and other things will happen in the site. And once the deal is settled, it will go to the posting, and this TBB1 posting and the payment. So once you did the payment, so I mean the TB1 posting, so that's all. The rest of the thing, monthly interest accrual or valuation, NPV will happen till something in the deal is matured, or you have sold that particular. This particular transaction is matured. Till this maturity happen, it will every month you need to do the valuation. So now this, so we have covered money market, forex, and derivatives also here. So the derivatives cover that, it includes that FRA, forward rate agreements, and the OTC options, swaps, and the cap floor and forex, and the listed options and futures. And so whatever comes under the derivatives, we are covering here in derivatives. And derivative can also be two, so OTC derivatives or exchange rated derivatives. Okay. Here this feature, what is the feature of this derivative? So the trading area group together the function of the entire derivative transaction, and also enables you to call up the information about the existing transaction and make the changes. Collective process is also available to help you manage your foreign exchange transaction efficiently, and these are the product types available in the derivatives. Here the product type is standard product types available. So I have worked on few, not all. I have worked on few based on the requirement, not all. So this is the OTC. For an example, OTC interest rate derivatives, swaps, forward rate agreement, cap flows, and these are the OTC options, currency options, and swaption and interest rate guarantee. So first of all, we need to know in the business term point of view, we need to know what the type of business they're doing and what the requirement means, not deep requirement. Overall, you can look at the balance sheet, any company's balance sheet. You should be having an idea what the sources of the fund and the applications of fund. Okay, so then you can, at higher level, you should be having in mind, okay, they're in application of fund, they are investing in FD, and they're investing in stocks, they are doing this kind of transaction, or you should be having some idea in mind. And the first thing you need to check if all the components are activated in the SAP Treasury area that is required to run. The list of components I can share at later point. Then we need to see the first of all the components that those components should be active. In SAP Treasury components should be active. Then we should go in the start in SPRO, and we should look at the Treasury module. And the first thing is we need to check what all the company code. Generally in the steps we start with the company code company code configuration with regards to SAP Treasury. We start from there. That means we should be configuring the global company code setting in Treasury. We should be having accounting, accounting valuation area and accounting code. So in SAP Treasury, accounting code represents the company code in FI. In FI you have the company code, but in SAP Treasury we have the accounting code. So accounting code and we should link the accounting code with company code and valuation area. So from here we need to start. I mean accounting code, company code, and the valuation area. And before that we need to look what all the general requirements, so that we should keep in mind. So what could be the scope of the work in general?
So basically, if we have an FI module already, and let's say there are 5 companies, we will have 5 company codes defined. So do we again need to do that, or that is already done?
No. In FI, or company code is already defined as FI. Okay. Now you should be relating, you should be configuring your company as the same company code you should fetch in Treasury, and you should create and assign an accounting code to the company. So accounting code is nothing but representation of the company code from FI. In FI we have the company code, and in SAP Treasury we have the accounting code. So we need to link that, we need to assign the accounting code to the company code. So again we need not touch the accounting code, okay, company code. We'll define our accounting code, and we'll in accounting code we will have the valuation. In valuation we have the accounting principle. Based on the requirement, we could have the multiple valuation area. Valuation area means it's accounting principle like US GAAP, IFRS, or IGAP, and these are assigned to the accounting code, and accounting code further assigned to the company code. That is how it is when you start creating a deal and you will be doing a valuation or accounting. Then it will be based on the valuation area. And in SAP FI, there will be a leading, non-leading, 0 and 1L, okay, something there. And that is also assigned in the valuation area here. So based on that setting, it will post the accounting. So first of all, we should have the company code global circuit setting and accounting code and valuation area. Okay. Then we should be starting with this product type, then transaction type, flow type, update type, condition type. And then it will go to the account assignment reference, then the position management procedures, then it will go, how a different process, how we should design our accrual process, deferral process, valuation process. Then the last part is how we should do the accounting, which GL should be triggered, when should be triggered, how should be triggered. So that's all actually. Overall treasury is like that. So here we are discussing that different product type of the derivatives like OTC, interest rate instrument, okay, interest rate swaps and currency swaps. So if you know this interest rate agreement, borrowing and lending, then you will be easily understanding interest rate swaps. Basically, two parties are mutually agreeing to exchange their interest rates, in the same currency. Okay. So suppose you have a variable interest rate, I have fixed interest rate, but I want to flip over. I want to we want to switch over. You want to pay fixed, but I want to pay variable. Then we can swap our interest rate. Okay, there is a product type, and we'll see that how it works there. Likewise, you can have the currency swap also. So in the currency swap, what we can do, we swap the exchange of the payment flows. That it means you have already the payment flows of the currency, particular currency you have forward rate is spot. Okay. In currency swap, you exchange your payment flow. Okay. Suppose I need to pay in USD, but you need to pay INR. We'll exchange, we'll flip. But likewise, the same as the interest rate, fixed and variable, we are flipping each other with each other. Here in the currency also, you have USD, I have INR. Okay, then you pay me INR, I pay you USD. It will, currency swap will happen. This will allow you cheaper access of the respective foreign exchange market, foreign currency market. Suppose you are the same currency, if you are taking from the outside, it will have a cost, but within your company code, within system concern, you can easily flip over the currencies exchanged by this currency swap option. Discounted swaps. Although I have not worked on this discounted swap, I worked on this interest rate swap, currency swaps, cross currency swap, but discount swaps I have not worked. So, but if required, I'll try to go through and how it works. Or anybody from you, if you have worked, then we can go through this also. And we have another product, compound swaps. So in compound swap, it basically the interest is capitalized and paid out during the end of the term, and whether or not nominal amounts are swapped in the process. So this compound swaps also I have not worked, literally saying I have not worked this discount swap and this compound swap. Because we could have so many type of swap, just like options, and just like we have the derivative option, different kind of option, future, vanilla, plain, and different, so many kind of. And it's on the variable side, but saying the interest rate adjustment takes place daily, where the weekend is calculated on the same amount. So basically, it's overall in the swap, we are exchanging our liability with each other. I have to pay in, I have INR, you have USD. We can exchange our currency, and same likewise. I have the variable interest rate. I am interested in to pay the variable interest rate, or you are interested in.
All right, let's test your knowledge. Here's a question for you. The SAP FSCM TRM module on ECC is primarily used for option A, automating accounts payable processes; option B, managing customer credit limits; option C, monitoring and mitigating financial risks; option D, optimizing inventory levels. Take a moment to think, and when you're ready, choose the correct option. Remember, each choice holds a key to unlocking the answer. Good luck. Type the correct answer in the comment section. Hey there, looking to master SAP FSCM TRM on ECC? Our course has got you covered. Take it at your own pace on our platform. In this course, you'll dive into SAP FSCM TRM on ECC, your go-to tool for managing supplies efficiently. From ensuring we have enough products to getting them where they need to go, we've got it all covered. Our course is comprehensive, covering everything from the basics to advanced strategies. Crafted by seasoned experts, you're in good hands. Your instructors are pros with years of experience. They're here to guide you through and answer any questions you may have. And guess what? Our students rave about the course. Folks just like you have found it incredibly helpful. The best part? It's budget friendly, so you can learn without breaking the bank. Ready to level up your SAP FSCM TRM on ECC skills? Sign up on our page now. For more info, head to ZaranTech's website.
Fixed, we can exchange. So here the forward rate agreements is also kind of derivatives. So can I say forward rate and forward rate agreement FRA and forward exchange that we already discussed in the forex forward, both are same thing. I mean what saying that if you have spot transaction or forward transaction, forward agreement is a OTC product, and OTC product that is more of what to say, it's not a standard product, but forward rate agreement that you can also see it's falling under OTC. Both are basically in that nature you need to pay some value to purchase it. Okay, so in the let me read out what's saying. So you can use the forward rate agreement to specify a fixed interest rate today for a period in the future. Okay, I mean you can fix the interest rate today itself. Just like in forward, we are fixing our exchange rate for the future exchange rate. Buyers of FRA covers themselves against rising interest. So you know that you have some assessment that you know that this interest rate will increase in the future. Then that's why you are taking the forward rate agreement today, so that you can mitigate the risk of increasing the interest. Just like forward points, we have forward agreement, not forward rate agreement, just simple the forward agreement, forward exchange agreement, where we fix the rate of that for a particular currency. I suppose INR against USD. Today, suppose it's 70 INR per USD, but we know it will increase to 73. That's why we approach to the bank and we agree to 72. Same thing. Cap floors, okay, the same thing is cap or floor is a series of interest rate options that are exercised when the options exceed or fall short on a certain interest rate. So it's an agreement basically between a party that if certain interest rate will fall or increase or exceed or fall, then it should be triggered. So based on that agreement, this should be exercised. But this cap and floor will look at, we will create the deal, we'll see how it works. So it's overall derivative processes. Okay, let me see this overall derivative processes. Okay, so it's same like business partners should be, first of all, business partners should be there. You can create an order, then you should create a contract, and once the contract is created and settled, monthly interest rate adjustment should happen, interest accrual should happen, and inside if the deal is settled, the correspondence will be generated, and account posting will happen, and this is how the overall process of the derivatives. Now the security process, the last one. Okay, so in security components, you'll be able to manage the security transaction positions and related to various security like subscription right, warrant bond, double bonds, I mean different kind of bond. So in a nutshell, I can say you will be able to manage your stocks. I mean, it's maybe preferential stock or I mean common share or the preferential share, a bond, or different type of securities, rights, or mutual funds. I mean debentures. I mean just like the bonds and convertible bonds, you will be having debentures and convertible debentures, non-convertible debentures and debentures. So you'll be able to manage all the security processes in it. And the processes will be the more or less, I think 70%, 60%, 70%, 80% processes are same. Once you start with the money market, all the processes are same. With some extent, the differences are there. Same means you need to have the business partner, you need to create a deal, you need to run the monthly valuation, you need to run the monthly accrual, you need to do the accounting. These processes are same, but depends on the product type, on the nature of the and the requirement of the product type. You may have to execute some additional steps, additional processes.
So, what do you guys think is a good SAP consultant with respect to the delivery and the requirements and the kind of knowledge, subject matter expertise that he can possess? Or let me rephrase my question. So you guys might have worked on these modules as well, MM, FI, SD, or other modules. So there's a slight difference between a good SAP MM consultant and a good SAP Treasury consultant. Do you have any idea what is the difference between a good SAP MM consultant or SAP FI consultant and a good SAP Treasury consultant? I won't say being an MM or FI or SD consultant requires a detailed level of subject matter expertise. But in Treasury, you need to be well versed with the functional part. You need to understand all of the stuff which is happening in the finance area of Treasury. You need to understand all of those modules, those money markets, derivatives, those securities and forex from the functional side. Technical is okay, the flows are okay, the cash flows, product types, transaction types, these are all okay. But what does for example, a fixed deposit offer you? You might have done a fixed deposit with an ICICI bank, let's say. What are the cash flows? Okay, you give the money out, you receive the money after a certain interval of time, and you receive that interest. Until and unless you understand the full functional aspects of a certain product, the fixed deposit is a very simple product, I would say. The complexity increases once you go into options. So you have those variable margins, initial margins. Once you go to swaps, swaps is extremely complex. So those 2008 crisis, the credit default swaps, the mortgages and all of this, if you understand on a basic level, it will be very beneficial for you to be a very good SAP TRM consultant. Not the same with SAP MM or FI consultant. You can be good technically, but it's okay if you are on par with your functional concepts. I would go to the extent of saying 70% functional and 30% technical, because technical is not that complex. You will be able to understand. Exception is your risk analyzers and all, and maybe IHC as well. But overall, you should be able to understand the configurations, the technical aspect, but functionally, you have to be well versed. So I would say after this session, you go and understand the flows of all the products which SAP offers or which are there in the financial markets. Okay. Some of the products which are there in the financial markets will not be directly implemented in SAP. You have to find a way around. If you don't understand the cash flows of a certain product, you won't be able to suggest a way around or a workaround in SAP to implement it technically. Talking about meanwhile, I'll talk a little about the SAP Treasury part. So, on overview level, SAP Treasury, SAP FSCM, Financial Supply Chain Management, these has different modules which helps a Treasury department to function. Okay. All of those decisions that you make outside the systems, you can always come to the system, record those decisions in the form of transactions, and apply various regulations on that. So when I say regulations, you have those accounting regulations with respect to the accruals, deferrals, with respect to the valuations and all. So all of these activities, you can come into SAP as a tool and you can perform all those activities. The decisions will be made outside. The decisions will not be made, barring certain concepts like the hedge management, effectiveness ratios and effectiveness test. But mainly the decisions will be made outside your systems. Your systems are just for recording certain decisions. Okay. This is, you might be well versed with other SAP systems as well. This is what happens everywhere.
In Treasury, talking about SAP Financial Supply Chain Management and more about SAP Treasury and Risk Management. So SAP Treasury and Risk Management, you have different modules where you can, for example, you decided to do a fixed deposit outside with the bank, you have surplus money, you are a safe organization, you do not believe in derivatives or options to speculate, okay, to speculate your money. You have certain obligations to your stakeholders in the form of equity. So you have to obligate that, and you are a safe organization. You go to a money market and you do a fixed deposit with a bank, or you do you can issue a commercial paper as well for borrowing and all, or you can do a loan, short term, long term, for borrowings. Okay, so all of these things, if you do a decision outside with the bank, you can come inside and record that in the money market module. Once you record that, you can follow the processes around the same, depending on whether it is your home currency or domestic currency fixed deposit, a foreign currency fixed deposit. The accounting regulations change with respect to certain things. We'll talk about that. Derivatives. How many of us understand what a forward is? Okay, I'll tell you my view. What actually is a forward and how might have the innovation might have happened for futures and options and swaps. So let's say, let's take a sugar example. You go to a shopkeeper. You don't want the sugar now, but you want it 2 months from now, because let's say you have a party at home. Okay. So you want 10 kgs of sugar. Now the price is, let's say 10 rupees per kg. You understand that the price will go up. It will be 15 after 2 months. What you do with the shopkeeper, you make an arrangement that I'll come to you 2 months later, you give me the sugar at 11 rupees, because that's an agreement. Okay. What is 11 here is the forward price. What is 10 was the spot price on that day on initiation. What is 15? Let's say the price is 15 on after 2 months when the maturity happens. That is the spot price on maturity. So you enter into a forward agreement at 11 rupees. And if you think you are a financial analyst and if you think the prices will go up, that's a good deal for you, right? So it is like 2 months later, you go to the shopkeeper, buy that sugar for 11 rupees, go to the market and sell it for 15. What is the gain and loss? 4 rupees. Okay. This is a forward agreement. What are the cons here? The cons are, you are, yes, because these are big organizations we'll be talking about. So these are certain aspects which have improved, but on a certain level, previously what happened was there was no obligation to obligate that agreement. Okay. If you don't go to the shopkeeper 2 months later, that is fine. If you don't obligate, that is fine. He will just abuse you, but it is okay for not to go to the shopkeeper. So there are no legal, I won't say legal because there are big organizations involved here. There are no obligations to include that agreement. Okay. So if the sugar prices are, let's say 9 rupees, it went against your analysis. It went from 10 to 9 and you fix the price at 11. You might not want to go because you have a loss of 2 rupees there. Due to this due to this problem, disadvantage, what happened was the financial regulations, the financial regulators, they tried to streamline or regulate the process of forwards. They built the futures. What is the sole difference between a forward and a future? A forward, you don't have an agreement, you don't have the obligation. But a future, what they do is, if you want to do a future contract, exactly same as a forward contract it is, same thing, 11 rupees, 15 rupees, that sugar example. But if you want to do a future contract, you have to deposit some margin upfront. You might have seen, you might have, some of you might have traded on exchanges as well in futures, FNO. So you might have seen once you try to do a future on equity, they ask you for 1/8 of the margin or 1/10 of the margin of the overall amount. So this is what exchanges do. You don't directly deal with the counterparty. In forwards, there was a counterparty risk as well. If you are in profit and the shopkeeper says, I don't know you, then you are at a counterparty risk, right? in this case, the counterparty is your exchange. Exchange brings the buyer, exchange brings the seller. You don't directly deal with the seller. That eliminates the risk of counterparty as well as your obligation. Because if you don't obligate, you lose the margin, right? This is how it was innovated from futures to forwards just because of the cons. Now again, in futures, you have to obligate even if the price is lesser than what you analyze. So from 11, it went to 8 and you are in no profit, you are in loss now and you don't want to do it. Thinking of this, thinking of investors in futures, they innovated the options. What is an option? An option is a right to exercise, right? You might be well versed with all of these concepts, but just to reiterate all of this, so my way rather, so how these were innovated. Options is a right to exercise. You can pull out of an agreement in between or before the tenure, before the maturity of that agreement, right? So this is the option it was given to the investors. In future, you don't have an option. Do not talk about the future prices that are traded on exchanges. Organizations do not do that. Okay, this is speculation. If this is about hedging, then organizations will wait until maturity for obligation of futures. Okay. In options, what happens is you get the right to exercise in between, or you get the right to expire. For the sugar example, at maturity, if the price was 11, if the price was 9, you see you have a loss of 2 rupees, you will not go ahead and exercise, right? You will expire. This is the right that exchange gives you. In the same way, if the price goes to 15, then you again have the right to exercise. Obviously, you will go ahead and exercise because you're making a profit of 4 rupees. If I tell you that you have a right to question me, okay, how would I respond in monetary terms? I'll say you give me 1,000 and you can question me anything, right? Any right which we provide to anyone comes at a cost. This cost is called as your premium, nothing else. You might have understood premium, but try and understand this way. The premium is the cost of your right. The right that you get to exercise or pull out of an agreement, this is what premium is. Okay? Premium is a cost. It cannot be recovered. Again, I'm not talking about speculation, trading premiums on exchanges. No. I'm talking about maturity, exercise, or expire. Because big organizations will not do speculation. Rather officially on paper, they will not do speculations, but so we'll talk only about hedging and not speculation. Okay. Swaps. Talking about swaps. So simple as the name suggests, you have the right to swap. You can get into an agreement to swap. Let's say it's an interest rate swap. You swap fixed interest with the floating, or you swap floating with the fixed, just to cover your interest rate risk, your currency risk. Okay, let me talk about the risk first. So you guys understand these risks, right? Interest rate risk, currency risk, and counterparty risk, commodity risk, and nowadays this is maybe SAP is not able to cater to that, but country risk is also there, because after 2008 there's a big country risk which happens. Okay, so these are the risks which an organization might have. They have a floating rate loan. The rate of the loan increases. They have an interest rate risk. They uh, organizations are nowadays they are big MNCs, and they do customers and vendors outside their own country. So they have forex risk, USD, INR, Euro, GBP. They'll do all of this stuff. They sell stuff in Euro, but they have to convert that in GBP because reporting is in GBP for their own country. You might have been seeing this as well. This is how the financial supply chain management looks. We will only be talking about the cash and liquidity, bank communication, in-house, and treasury and risk. Okay. In treasury and risk, you have a certain function. I'll just go my way to tell you the configurations to build the fundamentals. So there's a flow built rather than going through just telling you the nodes and how to configure it and all. So let's try to build a functional understanding of the technical configuration. Okay. You see this transaction manager here. You have all the modules here: money market, foreign exchange, securities, listed derivatives, OTC derivatives, trade finance, country specific functions. So these modules, these four here: money market, foreign exchange, security, and derivatives. Both of these are derivatives. So OTC you might understand, over the counter. Listed is on exchanges. This is SPRO. So okay, great. This is what you get when you log in. Then you go to the IMG SPRO. You click here SAP reference IMG. You get this financial supply chain management. You drop down and you click on Treasury and Risk Management. You see transaction manager. You see the money markets, foreign exchange, security, and derivatives. So we'll talk about the money markets first. Building blocks of the configuration. Okay, so building blocks of configuration, how do you build up upon something from ground level, and how do you utilize that for different case studies, for different business scenarios? Business might not immediately tell you I need a fixed deposit. He can tell you in a different way as well. Okay, so maybe for example, in Saudi, they have this loans, I forgot the name of the loan, but interest is haram. When we say that, that means interest is illegal. Okay. For those certain clients, they will tell you in a certain way that this is a kind of deposit arrangement that we do with the banks, with the Saudi banks. But you have to understand that functionally and come up here and try to fill up the gap. What do we understand by gaps in SAP is what SAP standard cannot do, and you have to do it through a custom functionality. That is nothing but SAP gaps. Okay. So talking about the building blocks of configuration, the first part of configuration is your product types. SAP you have worked on, you understand master data, you understand configurations, you understand in-client. Okay. I'll go ahead and say, to the extent of rather saying that product types and all of this configuration is indeed a setup, a kind of a setup of your master data. This is not master data. You cannot do it directly in client without opening the client or without doing a transport. But this is a kind of a master data for understanding. Okay. If you are a treasury manager, you did a fixed deposit outside, you have to come into the SAP system and you have to record that transaction. What is the first thing that you need? You need an identifier for that kind of instrument, a fixed term deposit. A product type is nothing but an identifier of that fixed term deposit. Okay. Define product types. So you define a kind of an identification with certain parameters as well. We will not go through each and every node. Even I don't know each and every node meaning of that, but we will go through most of the stuff that you will be able to be well versed with all of the configuration. You will be able to set up, you will be able to do the case studies, business scenarios and all, but not all the fields. Okay, you understand that, right? You might be working in SAP FI, MM as well. So you understand not each and every field is explainable, and I've also not worked on each and every field in my 10 years of experience. So we'll talk about most or 90% of the stuff. Okay, perfect. You see the identifiers here. They say a fixed term deposit. This is SAP standard. What they say a fixed term deposit, you can say it like 51A. Client does not like 51A, so you can create its own fixed term deposit. FTD, let's say, it takes all characters and numbers, alphanumeric. If I double click and how to define a product type, again it might take some time. Okay. You have defined a certain product type. Let's say FTD, fixed term deposit. You gave the text fixed term deposit. You gave the short term text just to identify the fixed term deposit. A product category is given by standard. It is certain for a certain kind of instruments. Okay, 600 for forex, 740 I think for options, or 720 or 700. I'm not sure. you have 640, 620, I think, for swaps. So all of these are defined by the system in the background settings. Okay, you cannot define a new product category. You can only build a new product type based on a product category. So how this comes is functionally, I gave you an example of that Saudi client, right? He told me interest is illegal, so I have to find a way. So I can play around this with product category, create something based on this product category, a new product type, and give some specification, we'll talk later, and try to create his requirement in the system. If it is very complex, I won't do that, I'll do something custom. Okay. Product category cannot be defined by you, it cannot be customized, it is only provided by the system. Interest calculation methodology, you have this actual by 360, 365. So how are the number of days divided by how much is used for the interest calculation? Effective interest method, so you have this different calculations for effective interest method as well. The fee calculations, the facility category is used for the facility products. The cash flow generation, I'm not sure, generation of zero flows for fixed interest rates. So I'm not sure about this setting. Yes, okay. So this is the drop down which will give you all the options. Most of these are there. There are certain Japanese banks which use their own interest calculation methodology based on a certain days, but you will get mostly everything in standard. If not, if certain calculation methodologies are not there, you have to build everything through a custom. Okay, it's not like you can calculate interest custom and use the same product types in a standard way. You have to go the other way. You have to do the custom way. So as someone said, always on any field you can do an F1 and read about. Okay, it does not allow me to open, but you guys can actually press an F1. Okay, it is exactly. So this is what some clients use. Some have some banks which use a different methodology. They add some basis points to the interest. Sometimes the interest does not get calculated correctly. You face this problem with IBOR reforms as well. So you might know, you are a finance consultant, you might know the LIBOR is transitioning out by the end of this year. So you have IBOR reforms, the regional rates, the local rates. So all of this concept actually boils down to that whether your interest amounts are matching or not. Okay, so you have different options here. You can try all of those options. The client can tell you that it is ICMA or it is IFB, ISDA. So based on that, either you select it directly based on the client input, or you can do some play around this. You can work around this and try to understand what method actually matches your interest. You can do some calculations on your Excel and use actual by 365, 6, 365 by 366, 365 actual by actual. So all of these calculations you can try, play around, and maybe try to match the interest as per the client requirements. Right. So I understand you guys are very good with the technical part. Just try and grasp the functional part as well. Okay, so be very well versed with the functional. Why interest rate, and rather than pressing buttons here, why the interest rate calculation methodology, what it is. Okay, so as you said, you can navigate from here, try to see the different calculations and all. Try to match the interest. Basically, the client will give you the methodology. If not, if the interests do not match, then you have to do your own calculations, thinking about different methodologies here, and just try to analyze more, drop down on certain aspects. There are more drop downs here. So you will try to understand that what are the formulas being used. Okay. Now, this configuration, once you do this configuration, I actually wanted to do this with the trade itself once you create a trade, but let's go ahead with the configuration first. This will automatically come into the trade, or you have an option. There are field status variants as well, where you suppress certain fields to be changed in a trade, but this option will be auto-populated. If I make it blank, this will not be auto-populated. Okay, this will be auto-populated. Fine. You have the option to change that as well, but with the field status, you can suppress that field as well. Fine. Any more questions on defining the product type? So you need to understand that money market offers you all the money market, debt market instruments. Okay. So be it a loan, a deposit, a commercial paper, or deposit at notice, all of this, or a cash flow transaction, facility transactions, all of this is being offered by SAP in the money market module. Okay. So someone talked about 550 product category. 51A fixed term deposit is 510. If I just drop down on this and see all the product categories available, you will have 52 520 for deposit at notice, 530 for commercial papers, 540 I think for cash flow transactions or facility, not sure. 550 is for interest rate instrument. So SAP calls it at interest rate instrument. You can have variable interest, you can have fixed interest, all of those kinds you can have in there. So 550 is for your loan, term loan, short-term loan, or mid-term loan. Anything which is related to a borrowing is an interest rate instrument. Until this opens. 560, yes, 560 is your facility. Facilities can be syndicated bilateral. 540 is your cash flow transaction. Then, so a facility is actually linked with a cash flow transaction because facilities do not understand cash flows as it is. As sole transactions, they do not understand cash flows. You have to link a certain cash flow to that facility transaction, and then based on that, the cash flows will be generated. So these are two different transactions which needs a link. So these are all the products which are offered in the money market. 510, 520, 530, 540, 550, 560, 580. There's a new one, current account style instrument. So all of these are offered. It can be like that the client says you entirely different thing than this, but you have to come down here and then identify if it is a money market transaction. There is loans management module as well that is separate. We'll not talk about that. But in treasury, doing a money market debt transaction, you have to come down here and boil down that requirement from the client into one of these instruments. Okay, you can play with certain aspects and you can implement that. Do you want me to go through all the products, how it is, because product type you just have to define the name and you just have to give the interest calculation methodology. Right, okay. So then let's talk about the interest rate instrument. So you said it's only for variable. No, it's for fixed as well. So you can do a fixed term loan from the interest rate instrument. Yes, maybe for your clients it is only used for variable. So clients can structure a fixed term deposit separately and a loan separately. Or they can use a loan, fixed term loan in the fixed term deposit, and they can use the interest rate instrument for variable loans. But it is capable to do the fixed loans as well, interest rate instrument. If you issue an interest rate instrument, you invest in it rather than borrowing money, it becomes a fixed term deposit. So you can play around with certain things here. You can do the variable part, you can do the fixed part, whatever is client requirement, but this is quite flexible. Okay, it is only based on the gap analysis that you do for the client requirement and what is offered by the standard. So you can come here and even do a fixed deposit and interest rate instrument as well. Okay, so at product type level, this is all same. You define a product type. Category does not change. You have to identify a certain category because certain financial mathematics runs behind this product category. You define actuals by 360, 365, the interest rate, interest calculation methodology and other. So this is how you define the product types. 53A you also want to go through. So 53A, a commercial paper. Commercial paper is, someone said it's a discounted instrument. So that's correct. It's a discounted instrument. You get, for example, you invested in a commercial paper. They will tell you a discounted price, let's say 100 rupees at that par face value. And they offered you a 90 rupees. So 90 rupees, sorry, just a moment. 90 rupees is your invested value. You buy that commercial paper with 90 rupees, and what you get in return at maturity is 100 rupees. A commercial paper's specific characteristic is it does not last more than a year. If you want to do more than a year, you do a loan, term loan or a deposit. Commercial paper is strictly 364 days. Okay. Understanding, I'll come to the cash flows part as well. So just a quick thing here in the commercial papers. The interest is I won't say inherited, but you try to understand it. This is in the price of the discount that you have been given. From a face value of 100, you get a invested value of 90. You only give 90 out, you get 100. That the interest is that 10 rupees. Okay. Some people wants that to be recorded separately. Some people wants that to be amortized over the term of the commercial paper. So depending on different requirements, it can be done. It can be recorded separately as well, the interest. It can be recorded as an amortization over the period of the tenure of the commercial paper. But at this level, we are just defining a commercial paper. We should know the product category. Again, this does not change, and other fields. Let's talk about deposited notice as well. You give a notice to the bank that I want to deposit for 15 days, extremely short term, 14 days, 7 days, 15 days, 30 days max. You deposit because you want liquidity. You know a vendor, from a vendor I bought some chairs, I have to pay him 1 month from now. So, but I have money now. So what I'll do is I'll deposit for 30 days or 14 days. And when that, when I give the notice, so specifically in financial terms, when I give the notice to the bank, they will return my money based on the interest, 14 days interest. Okay. I take that money and give it to the vendors. So extremely short term. So you can see now that SAP has given you many options here. Very short, very safe, a bit risky with the variable. So you can play around all of these instruments with respect to a client requirement. If that is clear, we can move ahead to transaction type. Or you want to see other instrument as well. But the product type remains same. We can talk about the overall instruments in detail later. But the product type is the nomenclature, a kind of a master data, but not exactly in SAP terms. You just identify certain products with a name, and you give and you create the product types. So they want to differentiate between the hedge accounting part for 55B, 55C, and with the normal plain vanilla 55A. So you can do it as well. For example, you have you want to do it for different subsidiaries, let's say. Okay. Certain subsidiaries will have certain requirements of loans. One subsidiary in Saudi follows 55B. This is for hedge accounting. I don't want to touch upon hedge accounting as of now, but we'll talk about when we talk about exposure management and hedge accounting later. This is specifically built, but you can build a 55B or a 55D yourself as well, because you don't want to touch the SAP standard and you want to build something which is more relatable to the client requirement. Or you understand this concept of centralized treasury, right? Nowadays, cost of being centralized, having a where there is tax treaties between countries, and treasuries are very cost effective. So they move to these countries and they centralize the treasury operations. So what do I mean by centralizing is, suppose I'm a big MNC, I have 200 subsidiaries in all the countries, and with respect to treasury and with respect to payments. So these are two different things. IHC is all about centralized payments, and treasury, here we can centralize the treasury. So when I talk about centralized treasury, so one of those subsidiaries has a loan requirement. What it will do, it will not directly go to the bank in its own country or in its own region. It will go to the centralized treasury, ask for that loan. That loan can be an intercompany loan, or that loan request can be like that, fill this request from a external bank. Okay, because you have better dynamics running with that external bank. The fees charged will be negotiable. So interest rates might be on a loan might be lower, on a fixed deposit might be higher, negotiable, because these are OTC instruments. Okay, so these can be negotiable. These are not listed on exchanges. So if one says 7 rupees, that has to be 7 because it is listed, it is visible. If OTC says 7, it can be negotiated to 6.5 or 7.5 based on a loan or a fixed term deposit. Centralized treasury goes ahead and fulfills that loan, or it is more relevant in case of forex. In loans it is not that relevant, but intercompany loans this is relevant. So a subsidiary takes a loan from the centralized treasury, from the parent company, from the treasury itself. That loan can be identified as a 55D for you, just to have a visual understanding. 55A is when treasury goes out and make a deal with the external bank. 55D, I'll skip this. 55D is when the subsidiary makes a deal with the treasury. The treasury gives the loan to the subsidiary. No external arrangement. Everything settles internally. The transaction types. What to do on a product type is being told to you by the transaction type. A fixed term deposit can be bought or sold, purchased or borrowing, investment or borrowing. Interest rate instrument can be investment or borrowing. So what it is that you want to do on a certain product is being told to you by the transaction type. Okay, this is how we define the transaction types. So you see here, 51A has what SAP has given, fixed term deposit with an investment. They have built a transaction type 100. They have built a transaction type investment with premium. They have built a transaction type borrowing. With this transaction type, you get to know what I am doing with 51A. So when we create the trade, this will be more visually impacting. So when you create the trade, you first thing you need is the product type. Then what to do on that product type, whether to invest or to borrow. And it follows. I'm pressing these configurations because these configurations are used for all the modules, be it any instrument, derivative, securities, anything. Just a slight variations here and there, but you always have the building blocks. Those are product types, transaction types, update types, condition types, flow types. Okay, so to understand this is imperative because this is the building block. This happens with every other module, every instrument. How to do a transaction type? So again, transaction category is well defined in a standard way. You cannot change it. For a certain product category, a transaction category is defined. So for example, for us relevant is 51A, 510 product category. You have the investments, you have the borrowing. 520, you have the investments, you have the borrowing. The nomenclature of a commercial paper CP goes like you can purchase or you can sell. So nothing different. Do not get intimidated by purchase or sale. It's investment or borrowing. That's it. Just the financial nomenclature says purchase and sale. 540 cash flow transaction, investment or borrowing. 550 again investment or borrowing, interest rate instrument. 560 is your facility. Whenever we talk about facilities in financial jargons, we say either it is obtained or it is assigned, right? Nothing to worry. Investment and borrowing, that's it. Perfect. So this is how you define a transaction type. This can be done by you. This is provided by system standard. The number ranges, the previous node I didn't touch upon. The number ranges defines that when you create a transaction with this combination, 51A and 100, what is the number that is going to be created as the transaction number? Processing category. You can define certain processes. Now, I will touch upon the various departments in a treasury landscape. So, if you are running a treasury department, if it is small, if it is mid, and if it is large, how these are different. A large organization always employs certain checks, certain kind of checks within treasury departments itself. First part of that I'd say a section of the department would be the back office. The back office guys analyzes all the transactions, make the data entry, or rather I should say front office. So first part is front office, analyzes all the transactions, make the trades with external banks, be it FX or be it third-party interfaces like 360T, Reval. They will make all those trades with external bank, come here and enter those transactions. Recording of transactions is the responsibility of front office. Back office, checking those transactions and settling those transactions is when I say settle, not in the functional way, but in the technical way. The settlement is a function. When we come to the trade, we'll see how the trades are settled. So settlement is a function which is performed by back office, or there are other things as well, like MT300 confirmations, MT320 or 305 for options. All of these concepts we'll talk about later, but just understand settlement is also a function. So settlement function is performed by the back office. They check the transactions, they see whether front office, whatever they have entered into the system is correct or not. They can attach certain papers, the legal deals which they do with the bank, and they can attach to the transaction. So back office has a visibility on those external transactions, that how it looked like with the external bank, whether you have entered the same numbers in the deal, and then they will settle if everything is fine. There is one more function which is for the managers. Back office, if it's a very big organization, back office can be divided into people who see the data and settle, and there is a manager who actually approves that, okay, let it go to posting. I'll talk about the flow later, but just remember this. So there is one guy who says, let it go to posting, let it post, let it go to FI. Okay. So this depends on clients. Some clients directly from contract to settlement front office does, and accounting team is involved later, and then the reporting team is there. The planning team who actually sees all the reports and sees whether the function is making sense, the reports are making sense. It can be a very big organization, certain checks at every level. Someone creates an order, someone creates a contract, converts that into a contract, someone sees that as a back office, settles it, a manager approves it as to release it to accounting, the accounting team posts it, and then if there is a planning team which looks at the report. Depends on the client, how big and how open. So it can also be like it is a big client and they don't want a large number of check boxes in the process. So they want it to be simple, directly create the deal, settle, and accounting. Everything of that functional aspect is controlled through here. The processing category for a certain product category can be defined like order, contract, and settlement. Okay. When I say with settlement and without settlement is, when you say without settlement, then you don't need to settle the contracts. When we come onto the trades, we will understand it better, because that will give you more visibility. But just trying to understand that without settlement, without involving back office to settle the transactions, and with settlement, yes, involve back office to settle the transaction. So client says that back office is there, you select with, back office is not there, you select without in the processing category. Automatic posting release is that manager concept which I told you, that he wants to approve before it is released for posting, released to accounting. So that check is here. Okay. You can do F1s and try to read it for your own benefit, for your own understanding. I'll tell you the overall functional view. This is, I don't want to go to transaction code, but this is TI90. I think TI90 or TI10, I'm not sure. But you release the transactions with a certain transaction code in SAP, and the manager does that. If this is checked, then this instrument is liable for that release manually. If this is not checked, then that release is not required. Client says manager is not there, you don't check it. Client says manager is there to approve for posting, you check it. Automatic settlement for counter confirmation. Now I will touch upon different, you understand these empty messages, right? With Swift, they innovated the empty messages for confirmation. All the banks have adopted, have actually been involved in that agreement, and they have adopted these messages for confirmation. It's a Swift. thing. MT is all Swift, but these are being adopted. They have implemented their systems to understand those messages and provide confirmation that you have done the deal. So specifically for an deal, the MT message which is relevant is MT320. We'll talk about that in detail when it comes to that. But MT320, let's say, is sent to a bank. What happens is when you create a transaction, obviously you have done an external deal with the bank somewhere, but you still need to confirm it through system. You create the transaction and MT320, which is configured at the background, gets generated and is being sent to the bank. Depends on whether you have different communication channels, the middleware, the POs, PI and all, but it is sent to the counterparty itself. Once the counterparty receives it, they send you back the confirmation that yes, you have done this deal, I confirm it. That is also in a certain format, MT320 only. That that concept is called as counter confirmation, matching. Okay. So if you tick this, you make it eligible, this product type, for counter confirmation, that if I send a MT320 out to the bank and I receive it from the bank, and if through certain programs, if I try to match both the confirmations, outgoing and incoming, then this deal will be automatically settled. There is no back office function here to settle the deal. They won't check. If I send it to the bank, it comes back to me, then the deal will automatically be settled. But not settled. Okay. We will again come on to this this node, this tick box, checkbox here, when we are talking about the MT300 320 configurations. Okay, and there are master data requirements as well for the counter confirmation. But just understand that this is yes for settlement, this is no, settlement is not required. My back office will settle, you just confirm, match. Okay. So you have certain options of doing a premium and discount here as well. With the commercial papers, you can define the nominal postings, the net present value. For cash flows, I'm not sure, this is maybe for cash management, but you can do an F1 and try to understand other fields. But the bare minimum or the basic things which I explained it to you, the transaction category defined by system, this is imperative. It tells you now from the functional side, this makes sense because you don't want for a certain company code the same transaction number as for other company code, right? For a certain product type, you don't want 51A and 52A to post the same numbers. That will be duplicated, right? So what you do is you ask for certain, you design the transactions, the number ranges in a certain way that all product types are posted with a different transaction number and starting with different things. So it's easy to identifiable. It is easy to identify that, let's say 900 is a fixed term deposit, 600 is a commercial paper, and 500 is a deposit account. If you understand all of this, we can move ahead. Any questions on these fields? So a contract is defined as, first, if I say order contract settlement, or I say contract settlement, or I say with settlement, without settlement, then the deal will be created in contract status. If I say with settlement, it will be settled by the back office, but your boss does not trust the back office 100%. He says there is a manager of the back office who wants to release it to the posting, because posting is a ledger, right? It will be in the balance sheets and the P&L statements. So he wants to only post once he is sure that this can be posted. So if I check this, there is an additional function. I forgot the T code, TI90 or something. If you check this transaction, if you check this this option here, then this function is active and you have to release the transaction before posting to FI. If you don't check this, then it is not required to release. So there is something called as TBB1 which posts these transactions, these flows to FI. TBB1 will not work if you do this and do not release the transaction. If you uncheck this, then only TBB1 will work without releasing the transaction. If you select with settlement, if you select without settlement, then this step is after contract. I'm mistaken here because it's vice versa. Automatic posting release, if this is checked, no release required. If this is not checked, then release required. Okay, so just make that amendment. It's vice versa what I said before. If checked, is there, then no release required, automatic it will be, and if check is not there, then release is required. So when you send a MT320 or MT300 out, you discuss those specifications with the bank, that this tag is required. You might have worked with payment files. So same kind of specifications are required for MT320, MT300 as well. You have certain tags with numbers where you send certain information, 21, 25, 57A, 53A, all of this information, the counterparty BICs, your big business identifier codes, all of this information is sent to the bank. What is the most important information is, what is the loan amount and what is the loan rate? And what is the maturity date? Okay, this is what you agree with the bank, that I will be sending a format like this to you.
Right.
Is this fine? He says yes, this is fine. Now bank will say, I will be sending a format like this to you. Is this fine? If I want to make changes, I don't need certain tags, or I need extra tags, then I can request the bank if it is possible for them to send it for my matching. Now how the matching happens? Matching is defined in configuration. So based on certain fields, I can define that, for example, if it is a loan, only see the loan amount, the counterparty BIC, because obviously if there are two loans with the same amount, same rate and same maturity with two different banks, I don't want to risk matching one with the different one, right? So I will say the counterparty BIC is mandatory, my BIC is mandatory in both files. So BIC is business identifier codes. For example, a Saudi Aramco client will have ARAMXXX something. Citibank on the counterparty will have Citi USXXX something. So these bits should match. This is the first priority. This is done by the system itself. The BIC you cannot say it should not match. Okay, this is at the background in system. What fields you can do more is customizable in the standard settings. So you can say the loan amount, the rate, the maturity. These three fields should match on both the outgoing and incoming files. So if all the three matches and obviously the BIC matches, then it will be matched. There are certain transactions to see that matching if they are common eye, and in the deal itself you can see the settlement as well and the correspondences as well. So this is the matching customization that we will be talking about. As I said, we will be talking about in advanced level when we are talking about configurations of MT300, MT320. And matching is also a configuration. But at a basic level, you define certain matching criteria that based on these three fields, outgoing and incoming should be same. And then if it is same, it should match. There are certain programs to upload FTR, Swift import and all to upload the files. Now talking about your transmission of files. So it is same as your payment files. It is same as any other IDOC file that you send to SAP instances, different systems, different external parties. So it is exactly same. You can have a PO as a middleware. You can have C burger party middleware. Okay. So what happens is you can have Swift in between PO and the bank as well. Okay. So what happens is you send a file to your directory, your AL11, your middleware, your PO, SAP PO is integrated with your SAP system. So PO picks up that file from AL11, sends it to the bank server. The bank server places the file on its own server. PO picks it up, okay, and sends it to the AL11 from where you can upload the income. So this is normal transmission, just like any other payment files. This is highly customizable as per the client security requirements. Some clients have 5 different middlewares in between because they are excessively, they have taken a hit of these malwares which are running, which were running some time back, no? So some clients don't have they just have a single middleware. Sometimes some clients have 5 or 6 middlewares in between just to see the reporting and overall impacts. Interfaces can be leveraged because your business counterparties can be your bank as well. So Citibank USA as a treasury counterparty can also be a house bank as Citibank. Okay. So for example, that interface can be leveraged from the banking side if Citibank is to be dealt with through the same interface for payments and through the same interface for treasury confirmations. That can be done, or you can have separate based on security. Totally client required or bank required. That's why I wanted to do this with the trade parallelly. One screen of configuration, one screen of trade. So if I just show you the FTR create screen, You see here why I stressed upon the product type, transaction type, because while you are creating a transaction, you need these identifiers, right? If you don't have an identifier, you cannot create. Business partner we'll talk about later. But these two things you require. Once you go inside, you require the flow types, update types at the background, condition types at the background. So this process is mandatory to understand your question. So your question is, will this happen after settlement? This automatic settlement for counter confirmation will happen after settlement? No, it will happen after contract. After contract, the confirmation is sent to the bank. It comes back and settles the deal automatically. From this stage to this stage, no manual settling, but it will be done by the system itself. Okay, this will be much more clear. That's why I wanted to do this parallelly, but it's okay to do the configuration first. Much more clear once I create a transaction and show you the end-to-end business process, how it happens, how a deal is managed. Okay. Number range is again the same thing that you use in that field of transaction type. The number range, you can define it here. You can define, for example, I'm not sure what company codes are configured. Let's say company code 1000 and...
All right, let's test your knowledge. Here's a question for you. Which of the following financial risks can be managed using the SAP FSCM TRM module on ECC? Option A, interest rate risk. Option B, foreign exchange risk. Option C, commodity risk management. Option D, all of the above. Take a moment to think, and when you're ready, choose the correct option. Remember, each choice holds a key to unlocking the answer. Good luck! Type the correct answer in the comment section. Hey there! Looking to master SAP FSCM TRM on ECC? Our course has got you covered. Take it at your own pace on our platform. In this course, you'll dive into SAP FSCM TRM on ECC, your go-to tool for managing supplies efficiently. From ensuring we have enough products to getting them where they need to go, we've got it all covered. Our course is comprehensive, covering everything from the basics to advanced strategies. Crafted by seasoned experts, you're in good hands. Your instructors are pros with years of experience. They're here to guide you through and answer any questions you may have. And guess what? Our students rave about the course. Folks just like you have found it incredibly helpful. The best part? It's budget friendly, so you can learn without breaking the bank. Ready to level up your SAP FSCM TRM on ECC skills? Sign up on our page now. For more info, head to ZaranTech's website.
You can see the intervals here. Not defined. You define that. You can give this number. This number is what you give in the transaction type field. Okay. From number, you can define it like a 10-digit 9. Okay, I'll define it for you. So interval, I'll give 0, 1. I'll give 9, 0. Okay. I'll give 9. Okay. 9, 0, 0, 0, 0, 0. How many? 3, 3, and 3. 10. Okay. Till 9, 9, 9, 9, 9, 9, 9, 9, 9. Okay. 3. Okay. 10. So this way, all the 9 transactions, for what product type I assign the transaction to the transaction type, what number range I assign, based on that, that product type will only be created starting with the number 9. And once you start creating the transaction, this is common number range objects like SNRO, and you give the objects and all, master data, all. So it works for everything. MMFI, for this treasury is this specific, but SNRO works for your everything. So once you create the transaction, that number 9000 will be here, and it gives you the status that the next number will be picked up once you create another transaction. Just like simple other FI concepts. In the introduction, I talked about the fixed term deposit, what it does. When I say what it does, it means what it offers you and what it takes from you. This is nothing but the cash flows. If you want to be a good SAP TRM consultant, you have to understand the cash flows resulting from a particular instrument. This gets complex with securities, with options, the variable margin, initial margin and stuff. But once you start reading through the cash flow, of a particular instrument, only then you can come here and define it. If client says fixed deposit, I want to implement, and you don't know the flows, cash flows of a fixed term deposit. I'm not talking about SAP cash flows. I'm talking about functional cash flows, what results in a fixed term deposit. Suppose I did a FD with the bank. I give money, I take money on on maturity, repayment, and I take interest. So my cash flows are, I do the investment, I get the repayment, which is an inflow. First is an outflow. Then I get the interest, which is an inflow. So if I don't understand these three cash flows of a fixed term deposit, which is the basic of all the instruments, it will get complex with more instruments. So if I don't understand, I cannot come here and define that, right? Here, what I define is, what are the cash flows required for basic level. I will define all which I need, and then I'll assign it to certain product types and transaction types. Okay, what are the cash flows required for a fixed term deposits? Let's say this screen was blank. A client told me to implement fixed term deposit. I did the product type, I did the transaction type, investment borrowing. Now I want to do the cash flow. I understand that a fixed term deposit, he says I only invest, I don't borrow through a fixed term deposit. He says I don't issue a fixed term deposit. So for me, it is very clear now that I will do a investment flow, I will do a final repayment flow, and I will do a nominal interest flow. Make sense? Client says that in between the fixed term deposit, I want to increase the amount. Okay, then this is borrowing increase, principal increase, it should be investment increase. So then I create more flow types which can assist me in between the transaction creation. Once I create the transaction, it will take these three flows, but in between, client says that I want to increase my investment, then I will use another flow to increase the investment. I'll show you when it comes to the trades. I want to decrease the investment in between. He says that. Then I need this flow. These are the cash flows which I need extra over the client requirement. Okay. Client says this will be more beneficial with the variable rate instruments. We'll talk about that. But for a fixed term deposit, this is the basic three flows that I will always come and configure because I know the flows functionally. Now for options, I know the premium is there. For futures, I know the initial margins are there, variable margins are there. All of these flows are there. So if I don't know that, I cannot come here and configure. What will I say? I don't know initial margin. What will I say here? Nothing, right? So you need to understand the cash flows of an instrument. That is imperative. Once you know that, you come here and define it. So let's see how a flow type looks like. I defined it as standard SAP. They defined it like 1100 for an investment increase. Now there can be different flows. One kind of cash flow is which is inherited in the structure of the deal. You cannot get away with that. If you buy that deal, that comes with it, something like that. Okay, so that is the structure cash flow. Okay, another is your other flows. You can have bank commissions, for example, different instruments. You can have separate bank commissions, bank charges. You can have withholding taxes based on certain interest amounts. All of those flows are other flows, which are not inherited in the structure and are based on certain OTC requirements for the bank. Bank says you pay me a charge of this. Again, you want to book this in the transaction itself. Then you do it through the other flows. Then you have flows for accrual deferral. All of these are listed here. Then you have flows for accrual deferral. Accrual deferral is your, we'll talk about it when we talk about the regulation. So this is the flow types which we define for accounting regulation, that every month end, the regulating body asks us to do an accrual or a deferral of an interest rate loan or a fixed term deposit. Even if you are receiving a fixed interest, after 1 year, you accrue it in your 1 month books because I want to see it. Because if you manipulate the interest later, you can inflate your P&L. Okay, so book accrual and show it in every month's book. Some clients follow a different procedure. We will talk about that configuration later as well, but we'll touch upon very basically what these things are. When it comes to that configuration, we'll detail it out. Certain clients want difference procedure. What a difference procedure is, they don't want the accruals to be resetted. Some clients want reset procedure. They want the interest to be resetted the very next day of the next month. So month and last day of the month you did the accrual and it will be resetted the first day of the next month. Some clients want that. Some clients do not want that. They want the difference procedure where accrual is only posted at month end and next month's accrual is calculated from that date, from accrual date. In case of reset, the accrual is calculated from first date, consolidated accrual from start date. Difference method, accrual starts from the accrual date. Okay, we'll talk about that detail. Then you have valuation. You have again an accounting regulation that okay, let's talk about this. Just ingrain this concept where we do accruals and where we do valuation. Accruals we will do only if it is about interest, fixed interest. Valuations we will do when the prices of certain things change. Will a money market domestic currency loan, fixed term deposit warrant accrual? Yes, it will, because it's a fixed interest. Will it warrant valuation? No, because it's a domestic currency. I'm doing a fixed term deposit in GBP. I'm GBP itself. I'm in UK. Why will I do a valuation of that? Because there is no currency difference, right? If a foreign currency loan or a foreign currency deposit is there, do you do an accrual? Yes, you do, because again interest is involved. But do you do valuation? Yes, because the loan was taken in euros, you will convert into GBP, so you have to post that gain and loss of the currency fluctuations. Okay, so that valuation you have to do. So it depends on the nature. FX always have valuations. Deposits and money markets depends upon foreign currency. If domestic currency, no valuations. Okay. So these are the classification of flows. Then you have transfer, the valuation class transfers and legacy data transfer. All of these migration flow types which you create. We'll talk about that as well later. But this is how you structure. Basically, you use everything for the structure characteristics until and unless you define, because these are defined by system as well, a standard, we use the system ones. Only if you have a hard-coded or a hardcore client requirement, then you go ahead and do those ADs. AD is a float, is a update type for accruals and deferrals. Okay, if you want to do a TPM 44 manual accrual with the flow type, then you can do it for accrual and deference here. So the structure characteristics defines that what all flow types you understand through a cash flow and what all you will define. You understand that this is very uniform and structured, right? In product type, you have product category, transaction type, you have transaction category, flow type, you have flow category. So all of these categories are defined by the system in the background. You cannot change it, you cannot customize it. If you customize it, all the system will be a mess and it will break down. Okay. So flow category, again on the same lines, product category, transaction category. Based on the flow category, you can define a flow. A flow category can be principal increase or other flows or principal decrease or final repayment. So for your principal increase for your investment, you will select a flow category 10. For your final repayment, you will select a flow category 12. For other flows, you will select 90. You can have charges or conditions as well, right? So structure within structure, you can have other flow as 90. If you select flow category 90, then it has different dynamics. For nominal interest, you can select 20. For others as well. So it is like same concept defined by system and a financial background mathematics runs through these flow categories, not to be changed, and you cannot change it actually. Okay. Calculation category is assigned, is coming from the flow category itself. Okay, so this is also background settings which are provided by system. So flow category brings in a calculation category just for system to understand the background financial mathematics involved. This is, when you do it here, this is done by the system itself in the background. The valuation update types and accrual deferral update types are called automatically through certain settings. only if it is very much required for a manual accrual deferral flow to be defined here, then it is done. Okay. So for example, your question that if I want to define a flow type with all those characteristics, I can do that, but I have to differentiate between the identifier and name it accordingly. And obviously the flow category has to be relevant. These checkboxes, so integrations are with different systems, and you can tell whether a flow type is relevant to cash and liquidity management. So if it is relevant for CM, then this flow will be automatically integrated into the cash position. We'll talk about the CM later. But here you can control whether a flow is required on the CM cash position sheet or not. Certain flows are required, certain flows are not required. For example, if I do an other flow, if I make another flow, I might not want it in on the cash position visibility, right? So if I do another flow here and create another flow, then I will say that this is not relevant to CM. I don't want it on my cash position. My cash position should only be structure by nominal flows. I can do that. Relevant to position. So relevant to position means if I say this is not relevant to position, then when I do the valuations, the book value and all. So what happens during valuations is you can use a straightforward method of not resetting, or you can use a reset as well, without reset and with reset. So what happens in without reset is your book value is being written up or written down. In without reset, because it with reset, it is a reset of the previous entry, your book value does not change. Okay. In order to make that relevant, to change that book value, this whether this flow is relevant for position, this is used for other positions as well, but whether it is relevant to change your position or it is a dummy flow. In withholding taxes, for example, if I say relevant to position, then yes, it will be relevant to your book value. If I say not relevant to position, then it will be a separate flow, recorded separately, accounted separately. Okay. Relevant to valuation, again, whether this flow needs to be this TPM one which we do at month-end valuation, whether it is relevant for that valuation. So if I select a valuation one, then I have to say relevant for valuation, and position flows are always relevant for valuation. Either the book value, your flow is relevant for valuation or not, I define it from here. Relevant for posting. Again, this is very important because in certain migration scenarios or in certain issues that you face with the clients, you might not want to post these flows. A flow which is, for example, you implemented SAP in a client today, but that client had loans or fixed term deposits 6 months back as well. But those are not matured, those are not expired. So this is called as bringing these deals into system is called as migration. Okay. So once you bring these deals, you don't want to post the principals. There are other ways as well. Update types not relevant for posting, and certain other things in the configuration as well. But just let's talk about only this checkbox. You don't want to post the investment, but maturity happens in the system itself, because maturity is 6 months after, investment occurred 6 months before. Okay. In those cases, you might opt to untick this for investment and tick this for repayment. What will happen is these flows will not be posted and the other flows will be posted. There are many other sophisticated and advanced ways to do the migration, TB1 LC, or create the migrated flows, or mark the update types not relevant for posting. But this is also a building block where you can define it. Okay, this is like, think of this as SAP came up with this, then they thought of other things as well where you can stop posting with the updates that they have. They learned from these checkboxes. So this was very primitive, and after that there were many other things where you can stop the posting. Perfect. Same thing relevant for P&L and relevant for accrual deferral. So interest will be relevant for P&L. This is your balance sheet, investments and all. And relevant for accrual deferral, whether this flow is relevant for accrual deferral. Again, there are more settings in the configuration, which is taking cues from here. But not only this, and those settings are also required to make a successful accrual deferral. But here we can say, is it relevant? Are the flows relevant? Any questions on relevancy? Perfect. Payment management, here you define, because the flows, once these are created, are paid from the system as well. You have this banking integrated with Treasury, and you do, once the flows are posted, they create a payment request, and those payment requests can be used by F111 to create a payment file and send it to the bank, and in turn they pay it on the value date. Here also, primitive level, you can define a payment request is required for this flow, yes, and for either incoming or outgoing, and for both. Or you can say none, no payment request required. If you want to settle the flows, for example, a commission flow is there which you don't want to pay it through the bank. You want to settle, you just want to reclass your P&L with that commission flow. Pull out entry from a moving asset and put it on the P&L, just to reclass the P&L to record commission separately. So that will not be a payment request, right? So it does not need to go to the bank. So you can say for that flow that none of the payment request is required. Or you can say this is only an outgoing flow, this is only an incoming, or you can say for both outgoing and incoming. Safe practices, you choose both. Individual payment, again, this is banking dynamics, and in the BP as well, this is defined. Individual payment is there is no netting involved. So, for example, you have two loans of the same currency, of the same business partner, of the same maturity, of the same start of term. You don't want to send this separately. You don't want to send this in one amount. So let's say 10,000, 10,000, 20,000 you don't want to send together. This is called netting. Okay. Same flows with certain same characteristics can be sent to the same bank with consolidated amount. You don't want that for this flow to happen. Then you can say individual payment. So once you say individual payment, always individually paid. If 10,000 amount, this will not be netted with any other amount during the banking processes, and it will be sent to the bank as 10,000 only. It will not be netted. Here I say none, you can say it for both. Okay, so these are certain fields, parameters where you define the flow type. Right, correct. So again, it is very primitive. That's why I said that once you do here, there are other checks as well. Okay, you have to do it in the BP as well. There are F11CU or FBZP settings as well. Okay, so all of these settings, if in place, then only individual payment can be done. So these are primitive, and after that SAP thought I'll give a check on other configurations as well to make checks on all the systems, all the modules. Okay, just to touch upon these interest installment repayments, we will talk about it when we create a variable or this interest rate instrument. So installment repayment is you don't want to repay full. You want to spread that over the tenure. Every 2 months, every 6 months, you want to make the installment of the repayment. That's what we do with our car loans, no, home loans, car loans. Same thing with installment repayment. There are certain dynamics which comes with it, which can only be explained with the transaction. Annuity repayment, annual. Interest capitalization, the interest which is received or you pay can be capitalized as well. Bank says, you give me an FD, invest an FD, and I will not pay you the interest, but I'll capitalize and add it to the book value. How this this thing helps you? Not taking an interest now, what will it do is it will increase the book value, and the next interest will be calculated on that inflated amount. So you get more interest. This is the benefit. How in system we do that? We define a flow type, and at the transaction level, I'll tell you how to select this. Okay. So until and unless you understand the cash flows and the requirements of the client, you cannot come here and define this. It's very difficult. First, you understand the product, then you understand the cash flows involved, and then you come here and define it based on the requirements. As of now, you have only defined solo flow types. How will the system know that this is for this product, this is for certain product? So that's why we assign the flow types to a certain product type and a transaction type. Whenever I do a 51A 100, 1100 flow type will always be available for me as an investment. 1120 and 1200 will always be available. They have not assigned it, I'm not sure why. But 1200 will also be available for, if it is here, then it will be available for your cash flows. Okay, we'll see how the cash flows look in a deal later when we come to the business processes. But until and unless it is assigned here, it is not available for your product type and transaction type. If client wants to do a decrease in the investment amount, he cannot do if this flow type is not assigned. Derived flows. These are not the derived business, the other kind of derived business transaction flows which we talk about, the TPM 18 or the valuation class transfers. These are the derived flows with respect to a certain condition. Okay, so for example, you have a FD and you want to do a you have certain interest which is to be received, or you do a loan. You have certain interest which is to be paid, but you want to deduct the withholding tax and pay it directly to the government by yourself. Okay, in that cases, how can it be automated to come as a cash flow? How can it be automated to come as a cash flow in the deal itself? This is the place where we define that on what flow type that derived flows will be derived. Okay, I'll just quickly touch upon this. Will be more beneficial, this screen. Then we have certain rules which we can play around. So for example, if I just try to configure this, I'll say effective from 2906, flow type 1100 or flow type interest 1200, a direction which is a paid direction will always find flow type. Let's see what is withholding tax, or it's okay, 1905. I got it somewhere. Yes, 1905. It will always find a 1905 with a direction in flow, because withholding tax you will retain and pay to the government based on either a fixed amount, calculation procedure, or a percentage rate. Okay. If I say a percentage rate, I can say 10% of this flow type, means interest amount, always bring a cash flow of withholding tax of 10%, and just put it in the cash flows of the deal. If I do this this configuration here and save it, whenever 1200 flow type is called in a transaction, it will always bring a withholding tax with it with an amount which is 10%. Clients may not say that it is fixed 10%. It can be different for different months, different deals. Then you don't have an option. You can only fix an amount from here, that it is fixed for every the deal. Again, don't want to go to the deal stuff, but we'll talk about when we come there. In the deal, you make an entry, you make a flow in the other flow tab with a varied amount. If every month the withholding tax varies. But if you want to automate it, you just come here and say 1200 always brings 1905 with this percentage, and it will be shown in the cash flow tab of the deal. Again, you won't have visibility. I'll show you when we see the deal. Okay, I'll save this for future reference. Let's talk about the calculation procedure. So you see the field here as well, right? Calculation procedure. Either it's a percentage or it's based on a procedure. So what is that procedure is? That procedure comes from here. You define a certain procedure. For example, let's say dummy. Okay, just save it. Select this currency dependent rules. So based on currencies, you can put a maximum amount and a minimum amount as well. Okay. So when I give this procedure to that node, which we discussed earlier, then it will see, okay, based on USD currency and maximum amount, then bring up that flow only for that currency. If the 1200 occurs in JPY and you have USD here, then it will not bring for JPY. It will only bring for USD. Okay. Amount dependent rules. We have to make an entry here. Okay. So amount limit based on a fixed amount, based on a percentage amount, it comes here for that currency for USD. And if the amount limit matches and based on a percentage, either on the fixed amount or a fixed amount, it can calculate your withholding taxes. So you can assign this whole package to the other node, or you can do a percentage there itself. It gives you more more flexible options with respect to assigning currencies and maximum minimum amounts which clients might have requirement, and then you can define the percentages over after all these checks, currency and amount limit, and then you can assign it to the main tag. So we saw this here, right? Here you can assign the calculation procedure. Instead of a percentage rate, you can do a calculation procedure, and I'll remove the percentage. I'll see the procedure because I saved it. So based on this procedure, now the calculations will work. Okay, so it comes as a package of giving more flexible options. That's it. Okay, so we discussed product, transaction, and flow. We'll start with update and conditions, and then we'll start with the accounting, the position management procedures, and then we will start with the deals. Deals make you understand that what these configurations are, so it's important to do that. Thank you. Okay, so we talked about treasury, we talked about different modules, the money markets, the derivatives, the securities, the forex, from the functional side, how this behaves. And we understood that to be a good financial consultant or a treasury consultant, you need to understand the cash flows very deeply. So any instrument, be it like you do it in your daily life. Many of us might have been active on stock exchanges, or maybe in the debt market as well, the bonds and all. So understanding the cash flows from the functional side is quite imperative. And if you don't understand the cash flows, the gap between the client requirement and SAP, that cannot be filled. Here in SAP, you will understand how that functional knowledge will convert into the different configuration modes. But if you don't have that functional knowledge, at least 50% of that functional knowledge, it will be very difficult to come here and give a good solution. Yes, you can copy configuration, but giving an excellent or a very, very profound solution is imperative. For this, you have to understand things functionally. So we discussed about, first thing we discussed about was money markets. Money markets, you have all of these instruments with respect to fixed term deposits or your interest rate instruments which cater to your short term loans, long term loans, or any kind of different requirements which clients have. We talked about that Saudi client where they do not treat interest as legal. So all of these kind of requirements can be done under this module with respect to certain loan arrangements. You have the commercial papers which were very short term. You had deposited notice extremely short term. You have the facilities where you can create different structure of the interest arrangements, and then you can assign different cash flow transactions to find the flows. How much I am taking from that facility. And based on that, you will be charged interest on that cash flows or the cash flow transaction that you will build. We talking about some technical part. We talked about the product types. Product types is just like an identifier. Think of this as a master data. It's not a master data in SAP terms, but just for your understanding. So kind of an identifier where you identify what product it is. We understand, we understood different fields in the product type configuration where you can define interest rate methodologies and some other fields. So this is just like master data. Second is transaction types. You have an identifier, and what to do on that identifier is being told by the transaction types. You have this borrowings, investments for plain vanilla money market instruments. It gets complex when it comes to forex. You have this forwards, you have spots, or you have NDFs, non-deliverable forwards. So based on that, what you want to do on that instrument is being told by the transaction types. We understood flow types, the cash flows that we have been talking about. You need to understand the cash flows of any. Do not confuse when I say structure, I say it very functionally. Do not confuse it with that node structure characteristics or valuation or accrual deferrals or other flows. Do not confuse that. That is just a terminology SAP uses. When I say structure, this is inherited in the heart of a financial product. So means the surroundings might differ with respect to different requirements, but the heart remains same. For example, an FD is always an investment done and you receive repayment with some interest. So these are the cash flows which are the heart of an FD. There can be requirements of increasing, decreasing the cash flows, withholding tax. So that is all surrounding information. But heart should be understood very well. So we talked about flow types and we understood how do we configure different flow types. First thing is you need to understand the cash flows of a transaction. Then you come here and just keep on configuring different flow types. It can be iterative as well. You might have to go back and forth, try to create transactions and see what flow types you need more for your different requirements, decrease, increase or any other. If that is fine, any more questions on the previous sessions? If not, then we can move ahead. To reiterate, these product types identifier, yes, for under this section, these are identifier for money market products, but the same building block is used in foreign exchange as well, product types, transaction types. Same building block is used in securities as well. A different tweaked way of using this because of the complexity involved in different modules, but the overall structure remains same. The identifiers and overall structure remains same. Okay, so these are the building blocks. So it's not only for debt market, money market, but it's the building block for everything. All the instruments I want to create, I should have a product type.
Okay, understood. Thank you.
Perfect. Okay, no more questions. Then we can move on to the update types. I've been telling you the functional meaning of these nodes. So for this here it goes. An update type, think of this as a carrier. Okay, so a carrier to a different module, your ledger. So FI ledger, where you report for to the different regulators, balance sheet and P&L. So your books, monthly reporting, quarterly reporting, semi-annual and annual reporting. So all of that consolidation happens in your FI. You might know from all other modules, everything is merging into FI with respect to accounting, right? So everything which has a money related consideration gets converted into an accounting entry and comes to FI. These update types are nothing but a carrier between SAP TRM and SAP FI. These take certain things. I'll tell you what these things are. These take certain packages from SAP TRM to SAP FI. If these are not there, the postings will not happen. Okay, what it takes. Every cash flow in treasury corresponds to an accounting entry. When we say an investment cash flow, we saw the flow type, right? So cash flows means one flow type corresponds to a accounting entry, a debit and a credit in FI. Okay, how this flow type, how this information from this flow type is integrated with SAP FI is governed by the update types. Okay, so once we define the update type, this is not a hard and fast rule, but there are exceptions because with the complexity, it is mandatory to define update types irrespective of whether it has a flow type or not. But you can consider for your better understanding that 70% of things of flow types do have an update type. There can be update types derived which do not require a flow type basic configuration and they can work on their own because these are derived from different positions. They do not have a flow type to carry. They take data based on certain positions and carry it to FI. So those update types are based on the complexity of Forex because you need to have that final gain and loss, TPM 18 and all securities or listed derivatives, OTC derivatives. So based on the complexity, this 30% of the concept is an exception. The 70% is every cash flow, every flow type should have an update type to take it to FI. Okay. Let's see how this look. So again, everything until and unless you want to configure something exceptional for the client, everything SAP provides. Every flow type is there for every update type is there for a flow type. Okay, so you might have read about this Venn diagrams, right? Subsets and set. So update types, flow types are subset of update types, but not vice versa. Update types can be more, but every flow type should have an update type to carry. 100% of flow types should have an update type to carry, but not all update types need a flow type to function. Okay. So this is how it is defined. Normally, we consider to configure this like for different modules within Treasury. So if it is money market, we start this with MM and we do it like the flow type and with the direction. Okay. So a flow type 1100 can have a direction of both plus and minus. So that's why it has two update types. But that flow obviously will be posted only once, right? So one flow always is mapped for a particular direction, is always mapped. We'll see the mappings there. Will always be mapped to a particular update type. So this is how the update types look. So you just give the nomenclature, give the description here, and then you assign it to usages where this update type is used. Now this update type can be used in transaction manager, this update type can be used in accrual deferrals, this update type can be used in valuation or valuation class transfers. Everything provided standard way by system, but only if you need to configure something separate for accrual deferrals or valuation class transfer, then you need to come here and just assign it separately. Else if you create a new update type, most of the in most ways you will always assign it to the transaction manager itself, because that is what the structure is and this is where you want the requirements to be handled. Okay, so these are the areas where you can define an update type. You can define it for valuation class transfer, you can define it for account assignment reference transfer, so TPM 28 I think. So all of these things you can do, but very specific, we'll come on to that when we are talking about those things. But mainly it is about transaction management, and at most if you want to separate out the accrual deferral, then you can do it for accrual deferrals. Every other thing is defined by SAP until and unless you have many different requirements from the client. Even if different requirements, you might find a way to play around with the standard settings only. You might not need to come here and create more section or different category of update types. Might only need transaction managers, accrual deferral, valuation class transfer is also defined. Okay. So this is how you assign an update type to different kind of a usage. If transaction
Can I ask a question, please?
Yeah, please go ahead.
So, sorry, just to get some clarity, let's say I have to use a fixed deposit, which is a product. So I'm just going by the flow. My transaction type is investment because I'm going to place an FD. My first cash flow would be FD investment. So I'm going to pay the bank to place an FD. So that will be my flow type, if I'm not wrong.
Correct.
And what will be the update type for this then in this example?
Okay. So I'll just go to the define update types. So you have an investment done, which is an outflow, right?
Right, right.
It is always from your perspective. So from your perspective, you have done an outflow. So 1100 you created as an flow type, an update type for that outflow, because minus and plus, I'll tell you why it is separate minus and plus, because this needs to carry the information of debit and credit to FI. So it needs to have that plus and minus outgoing or incoming to understand which is debit and which is credit. Okay, that's why these are two for outgoing and incoming. But always one flow will always be mapped to a single update type. I won't say mapped, but one flow will always be carried by a single update type to FI, depending on whether that flow is outgoing or incoming. So in your scenario, 1100 was your flow type, which was investment, and 1100 minus MM1100 minus will be your update type, which will carry your investment to accounting.
Okay, understood. And these update types have to be defined to a flow type. There is no automatic way the system will do it, right? It has to
No,
be
we'll
defined.
talk about that. There is the next note talks about the assignment.
Okay. So is it safe to say that any connection of treasury module with finance will happen necessarily through update types?
Let me think. Yes, no other way.
Okay. And is there any other purpose of update type, I mean, beyond defining the nature of transaction, the direction of transaction, or the cash flow basically for the finance module?
Other purposes, it depends on the requirement. Sometimes you create an update type not to post itself, to suppress the flows. And you say update types are not relevant for posting. But basically 99%, this is carrying your cash flows to accounting.
Okay. So no purpose for management reporting or transaction reporting. It's largely for
No.
accounting.
Absolutely. You might have some translations in FX or uh, uh, in underlines where the prices change. So translations of the purchase values, you might have that, which are not carrying the accounting, but which are generating the flows which carry the accounting, the update types which carry the accounting. So yes, you can think of this like 99%. No update type will finish in treasury until you have a specific requirement and always reach FI.
Understood. Understood. And you also mentioned the requirement for suppressing accounting flow. So there are cases where we have seen in business, and I mean in some system projects also, where companies don't want to post an entry because that entry has to be manually posted in a different system, let's say a consolidation system. So in those cases, what they want is in SAP Treasury, they don't want the accounting entry to be posted in FI, and they want to suppress the entry. So
Correct.
you mentioned that that also is possible by defining an update type, which is just a dummy update type sort of a thing, and then it will not get linked to SAP Finance. Is that correct?
Absolutely. Absolutely.
Okay. Okay.
So you
Thank you.
can define a dummy or you can define a proper one, and then you can deactivate the link through that update type between TRM subledger and the FI ledger. In fact, see, you will get to know once we move through the different modules. Security account management is used for securities because a little complexity involved in the management of securities. That's why we assign always different update types, because the calculation methodology at the background can be a slightly different, okay, with respect to the condition. So once we assign an update type to security account management, and then here we have, sorry, I'm jumping on to different things. So securities and security account management is here where we come and configure. You will have the option here as well. The update types option, obviously I said no, product types and flow types and everything is in all the modules. So once we come here and assign update types for security account management, then we will see how it behaves. Because that is your purchase flow of the securities. That is the structure part. Okay, your SAM 5000, your interest, your dividends. So all of these can be defined in security account management. Which are the conditions? We'll talk about that. Don't jump into different things. This is a slightly complex thing. So 70% building block will be same for all the modules. Slight exceptions because Forex is not same as money market, right? Securities are not same as money market. There are other things which needs to be taken care. So we'll talk when we reach the securities. You're right. I think SC 1000 is a purchase. And SAM 5000, 5100 you can define with respect to incoming, outgoing, interest flows, interest conditions, which comes up in FWZZ later, FWZE later. And because the governing factors are different, you have dividend factor values or you have the coupons on the interest. So governing factors are different, not same as money markets. That's why we have a slight exception in configuration for different modules. So you might have seen, I've clicked on this, you might have seen the transition, how it happens in the configuration. First you define the product types, and when you define the transaction types, you find a way to link product types with transaction types. Then you define the flow types and you find a way to link that product type, transaction type and flow type with the product type and transaction type with the flow type. Moving on to the update types, you have to find a link to link it either with the flow type or the product type or the transaction type, right? If we do it with the flow type, obviously the flow type is at the background, another configuration, it was linked to product type, transaction type. So that integration works for me. It's like a plain vanilla SAP integration concept, like in MM or FI. One node is integrated to other is to the next one, but maybe no direct integration between the fourth and the first, but integration works because both are linked. So here again, if you create just the update types and do not assign, the system will not understand from what is this update type, from what is the flow type that is being called, and what is the update type for the same. So to understand this, to map this, what we do is we assign the flow types to the update type. Flow types are in turn in different configurations, which we have seen already, are in turn assigned to the product types and the transaction. So that's how the integration works. So how do you define is you have different modules here. You can, for your flow type and update type, which is relevant for money market, you can choose money market here. You can give your flow type 1100 and you can give your update type. We'll see specifically for money market is 5, right? So let's say this, okay. So 1100 flow type is linked to your update type 1100 minus. Okay, they created different for borrowing 1100 borrowing increase, 1100 5 plus. For decreases, they created single flow type and mapped it to plus and minus. So this can be used for both reducing the amount or increasing the amount. One flow type can be assigned to 2 update types depending on the direction, but the carrier to FI happens only with one update type based on what is your debit and credit with respect to the flow, outgoing or incoming. Yes, you can define an update type for that as well. Actually, system needs an update type for treasury deal as well, because it assumes that we will always post it. Then because we talked about the flow type checks are quite primitive. And after that, SAP built many checks in other areas as well to stop postings. Okay, so that primitive, if you untick that, that will not be posted, but you have to assign an update type because deal will not be created, because deal always assumes, deal does not assume that you will not post it. It always assumes that you have to post it. And later you can define something where you don't post it actually. So deal will be created only if you define assign update types with the flow types. Condition types. So functional way of thinking is what is a condition in general terms? What is a condition? Condition is based on certain parameters, right? So this happens, then this happens. So this is what a condition is, right? Conditional agreements or some just general English. So conditional things means it depends on certain logic or certain things to happen. Same way in SAP also, these are extensively used. Update types, flow types, transaction type, product type might not be used in MM or FI or any other thing, but in the configuration of other modules. But condition type is a general concept used by SAP in MM as well, in SD as well. What does condition type say? It asks you how much is the percentage or what is the condition to calculate. Okay. I don't require condition types for all the flow types because certain flow types are data entry. They are inherited as understood. System do not need to spend that logic to understand that flow type, that flow. But certain flows require condition types to be understood and to be calculated. Example, interest flow should have a condition type because interest flow is automatically calculated that you did an investment of 10,000 INR and with the interest of 10%. So how much is the interest to be calculated? You don't explicitly tell the system that this is the interest to be calculated. System calculates by itself, right? 100 rupees or 1000 rupees, 10%. So system, if it needs to calculate from a certain logic, it needs a condition type for the same. Every interest flow does require a condition type to be set up and mapped to the flow type for to understand that percentage and to find the amount from the nominal amounts, or it gets complex when it goes to securities because there are huge calculations in there. Okay. Now you tell me in case of an FD, investment flow is there, repayment flow is there, and interest flow is there. For what all flows do you need a condition type? Okay, because this is data entry told by user to the system. 10,000 I'm investing. That is not governed. That is not cannot be calculated by the system itself. No. How do system know that I'm going to do an 10,000 FD with ICICI? Only if I come to system and enter that amount, then only system will know, right? So no investment. What about repayment? Does it require a condition type? You created a flow type that is only to find a flow of investment. But how will the system know that you invested 10,000? It's always in all cases that you will get 10,000 back. That is how the configuration is done. But still, system should assume certain percentage of return, right? Because in other cases like installment repayment or annuity repayment, system might assume that percentage is different and spread it over the tenure. So what is the percentage system will assume in case of plain vanilla, that 100% return? I told you, 100% return system should assume. Even if 100% is appearing, it does need a condition type for repayment. Okay? Because it has to say 100% somewhere. System is not a human. It is not smart. It does not assume that if you invest and if you get, you will get the same amount. System needs certain kicks. Okay, to understand that yes, 100% of that principal will be returned. So that's why I need a condition type for repayment. Anything else is the general logic. We'll see how it works. There can be exceptions. I'm telling you again and again, can be exceptions when we move ahead with the complexity of other modules. Wherever logic is there and system is not smart to do the calculations in its own brain, it has to run certain codes and algorithms at the background. It needs to find certain inputs of to that logic to find a number. Wherever that happens, condition type is required. You do this in FTR edit, you have all of these functions. I'm not sure auto rollover functionality is provided by SAP. Is there any auto rollover functionality? Sorry to jump the gun. So this is the transaction which tells you all the BAPIs which are active for standard BAPIs which are active for treasury. Okay. If you try to do a custom thing and pull in all these BAPIs and then you schedule a job that dependent job, event triggered job, that this end date, this function will run, this custom transaction will run with certain BAPIs of rollover, and it will automatically roll over all the transactions maturing on that date. That can be done, but in a standard way, I don't think that is possible. Automation is not possible in a standard way. For example, a fixed term deposit, you can have this rollover BAPI, but it should be included in a custom transaction with different BAPIs to commit, transaction commit and all. So it requires certain custom stuff to do it, automation. But again, there will be multiple logics because event based, again, based on the date can be slightly tricky. But we can find a way to do this, but only with custom. You cannot do this with standard. So this, I think, is the BAPI for your rollovers. How rollover functionality works is entirely different. The condition types we discussed. If you need a calculation logic to be derived, a condition type is required. That's why you don't see 1100 here, because that is data entry. You only see 1120 and the interest ones and installment repayment, annuity and interest capitalization. Wherever logic is there to be considered by SAP to find the number, you need a condition type. It depends on your transaction itself. In the so it is a thumb rule. Any intermediate changes you need to do in the structure of the deal, most probably it will not require a configuration change. Okay, with respect to the interest or conditions, it can be done directly in the deal. You can say this condition is valid from this date to this date for an interest of 1%, and due dates might be different. Number of days to calculate that interest might be different on that condition. You can stop that condition at that date and create a new condition in the deal itself. Okay, which says from this date 2% of interest with ICMA, interest calculation methodology. Previous was, let's say, actual by actual. Now it is ICMA. And you can separate out conditions. So based on that condition, system is smart enough to understand how much is the amount till that date and how much is the amount till later date after the changes. So this is all of this stuff majorly is done in the transaction itself. Only if it is extreme requirement, you come here and define maybe a new condition type. No, you have to create a new deal, but 99% of the scenarios, you will not be changing anything in the configuration. You will manage from the transaction itself, the front end deal itself. So most of the thing, 99.9% can be done in the deal itself, different permutation combinations to understand the client requirement. But very, very rare you might have to come here and create a new flow, put it in the other flows or derive it through certain logics. But mostly it will be done through the deals itself. So condition type, final repayment, this is what we created. We again give the structure characteristics because it is related to a flow type. We gave the condition category. Again, I'm reiterating on things. Everything has a category. Flow type, transaction type, product type, condition type also has a category because this is financial mathematics running at the background. So it needs a category and it needs to derive the calculation type based on that category. So it can understand what kind of a flow is that. This is all standard given by SAP. You cannot change it. Okay. Once you define it, so for example, you have different condition types for different things. So principal increase, decrease, final repayment, installment repayment, annuity, and all of this have a condition type or this condition category defined. And then you can assign the flow type here as well with the condition type itself. So once you define the condition type, you can assign this to the transaction type itself. It is being called at the transaction level. So you can assign it to 51A, 100 transaction and a condition type for the same final repayment. Okay, keep all the directions open. It can be used for both directions. This is fine. The integration of these 5 building blocks is fine for you. Okay, perfect. Once you do this and certain configurations here, we will be able to create the deal. Now I will go like, because this is more, it will be more absorbing for you guys if I do the transaction parallelly and show you where it points to the configuration. So this will be more beneficial. So with this bare minimum settings of these types, you can actually go ahead and create a transaction itself.
All right, let's test your knowledge. Here's a question for you. What is the primary purpose of the cash flow analyzer component within the SAP FSCM TRM module on ECC, option A, to forecast future cash inflows and outflows? Option B, to manage customer credit limits. Option C, to track vendor payments. Option D, to generate financial reports. Take a moment to think, and when you're ready, choose the correct option. Remember, each choice holds a key to unlocking the answer. Good luck. Type the correct answer in the comments section. Hey there, looking to master SAP FSCM TRM on ECC? Our course has got you covered. Take it at your own pace on our platform. In this course, you'll dive into SAP FSCM TRM on ECC, your go-to tool for managing supplies efficiently. From ensuring we have enough products to getting them where they need to go, we've got it all covered. Our course is comprehensive, covering everything from the basics to advanced strategies. Crafted by seasoned experts, you're in good hands. Your instructors are pros with years of experience. They're here to guide you through and answer any questions you may have. And guess what? Our students rave about the course. Folks just like you have found it incredibly helpful. The best part? It's budget friendly, so you can learn without breaking the bank. Ready to level up your SAP FSCM TRM on ECC skills? Sign up on our page now. For more info, head to ZaranTech's website.
Within that transaction, we will see the flow, the business process flow, how the transaction flows across, and based on that, we will see what all configuration is required. First, we will see the configuration first, then we will go to the flow of the business transaction. So now this configuration we have seen, and now I'll show which product do you want me to demonstrate. Okay, so let's say this is your bread and butter transaction, FTR_create. This creates everything. Let's say, because this is SAP 1000 company code and I do a FTD. FTD is there, but transaction type is not there. You can see no values find. We created FTD right that day. So what I'll do is I'll show you FTD. FTD fixed term deposit Saudi was created like this, actual by 360. If it was not created, then it should not have appeared here. So this drop down, just like SAP normal concept, this drop down works from that configuration. Now this says no values found for the transaction type. What we'll do is we'll configure the transaction type for this. So FTD is not there. Let's see, let's copy FTD with an investment flow. Let's say I define the number ranges as well. Let's say I need the contract and settlement. So I'll find that. You understand FX, right? How FX dealing happens? So yes, I configured and it is now appearing. So system is indeed able to find it. Let's talk about the business concept, partner concept later. We'll find some business partner which is not there. So we have to create it. So I'll create a BP. I'll not go into the deep concept of a BP, but maybe later. But as of now, I'll just create one BP for this transaction flow perspective. You might understand that a BP can be used by whole FSCM. Okay, that's why it has different roles to perform. It can be created as a general business partner, but for treasury or IHC or collections and dispute or some other module in FSCM, it needs to be defined for a certain role. For treasury, it specifically has to be a counterparty role when we talk about plain vanilla FX or MM. When it comes to securities, just because of the dynamics of securities, you need an issuer to issue the security. You need a depository bank, just like your demat account. Dematerialized account is there for you in the stock market. That is mandatory for you to trade. Same way, there is a depository bank which keeps those purchased securities in a certain account. Okay, and then you have the counterparty. Issuer, depository bank, and then you have the counterparty. So counterparty is essential for all the transactions. If you want to do a transaction with them, you can have different issuer, different depository, and different counterparty for a security. We will talk about that later, not now. So let's say the business partner I created, but I do need to create a counterparty role for this business partner. Else, Treasury will not be able to deal with this. Why they do this is because they want to upgrade. This is an upgrade to their system with respect to the new things that they identify with different clients, issues or requirements. That is why SAP is slowly increasing that with standard SAP you can achieve 60% of your requirements. If you are smart, if you want to do custom, then you have to do custom. Nobody can stop you. But if you are smart, you will find a way in the standard configuration and standard settings itself. 60% you can do for a client for which the treasury is huge. For the clients for which the treasury is not that huge, you can do totally 100% standard config, no extra custom. Maybe for the reporting, because SAP does not cater well to the reporting needs of different clients. But with respect to the business processes, majorly can be handled through standard. Okay. Now that 60%, what SAP also gives you, it gives you different enhancement spots or different BAPIs. When I talk about enhancement spot, these are specifically about bodies. It tells you that if you want to change my code, because I have written a code making an integration of first line with the last line. If you write an implicit enhancement somewhere, sorry, I'm using these words, but there is no easier way to say this. So implicit enhancement is you change the code by your own will.
Okay.
Behind this, there is a code running. When I execute slash and BP, a code runs, and that's why the front end screen of BP comes. When I enter the selection, it again runs a code and enters into the next screen. So a code is driving this. SAP says I've written a code this by myself. Now, if you have learned ABAP and you want to change this code by implicit enhancement, I don't take responsibility. But seeing certain client requirements, because these are quite common now and genuine, I give you enhancement spots to put the code, put that part of your conditions in there. This is nothing but your bodies.
Okay.
Okay. So you don't do implicit enhancements, and I give you a certain enhancement spot. If that is also not funding your requirement, then you go totally separate custom. Do not touch my code. Certain people do touch the code. They also face the consequences as well. The stabilization period of implicit enhancement is at least 3 months for a common change, for a common SCR or a common change. Because that part of the code is also taking cues from the other part of the code, which a normal ABAPer is not able to understand. Okay, that's why they have their own people writing notes. They also do implicit enhancements, but through the notes. But those are SAP developers. Okay, they run the checks for the entire code, whether it is in synchronization with the other concepts as well, and then only they release those notes. Some notes also have the code changes. So bodies are that, and BAPIs are, they have built a function module. BAPIs are your function module. They build this function module packages which you can directly take and put into a custom program with your logic around the surroundings and utilize that functionality. You might have seen the BAPIs are working across SAP. Okay, but to fetch the exchange rates, to fetch the working days from the calendars. This is also relevant for FI, MM and everything. No? There are FMs working, function modules, which are nothing but BAPIs. FMs working, which are fetching, which can work as a package, and you give an input to that function module. It gives you the relevant output for that functionality. Now this functionality you can fit in your custom program, so you don't have to write that part of the code again. You don't have to pick data from the tables itself. You do it from the FM. Okay. Body is enhancement spot in the standard program. BAPI is if you want to build a custom program, then you can utilize that function module as a package and build your code around that. You can write lines surrounding to that BAPI. Now we can see the errors are going away slowly. Company code was okay. Product type we defined, that's why it got away. Transaction type we defined, that's why it is now not appearing. And partner we again defined in the counterparty role in the and authorized it for the FTD for this transaction, and that's why it has gone away. Now new errors have come up from the configuration. Transaction cannot be created without flow type for principal increase. So here we will see we created the transaction type, right? Now we will create the flow types. Flow types are already there, but I'll map my FTD to these flow types. So I'll just copy 1100, 1120, and maybe I have to create 1200 separately. So I'll say FTD 100 also maps to 1100, FTD 100 also maps to 1120. Okay, I'll create one more for interest. So 1200. FTD now maps to all three. Let's see whether we get the error. Okay, every time you have to go back. Okay, you got the error there also. Got the error. Transaction cannot be edited without condition type for nominal interest. Let's go back. let's do the condition types here. So define is already done. We will assign it to our product. So 1120 and 1200, we will assign it for FTP. FTP. Perfect. You got the flow, right? This is how the configuration behaves. Once you start doing the transactions, it will point to these configurations one by one, and then you can actually come and configure and actually go ahead with this thing. You might have seen update types have not come up, but it will come up during saving internal. This is how it appears. You have the business partner and flow type, and I gave 1 million, it got, it took the zeros. I gave a 0 here, it took the date. I gave a plus plus 2, 2 months later, it is now 3 months later because we changed the dates. I gave a percentage rate here, which is 1%. This is how the cash flows look. I said monthly, so it converted to monthly. If I say, let's say not daily, I'll say on first day of the month. If I say daily, it will be a big 90 lines. Okay, so first day of the month, it says every first day of the month, irrespective of start date. If the start date was even 25th of July, then again the interest would be received on first day of the month for the consecutive months as well. Irrespective of the start date, the interest is always received on the first date of the month. So you can play around with the structure here. And you can cater to the client requirement of monthly, daily, or manual input, or first day, last day, end of the term. End of the term means only at maturity. Condition for the, okay, I'll go back to that, first I'll explain you. So you can say effective from 3/7/2021, this is the condition which is going to happen, right? I can say fixed interest rate, or I can say an amount, fixed amount which will be charged. I can give that amount. Or I can say a fixed interest rate. One, I can change the interest calculation methodologies. I can give the end of interest period and due date. So you want to calculate only till 6th and want to get on 7th, right? If I do this, then the interest will be received on 7th, and it will only calculation will only run till 6th. So this is how you cater to different requirements from the client. Interest, random interest, not consistent interest in between, and you build the conditions for this effective date. This effective date, and I can copy the condition. Okay, you can say the effective date is, let's say, 4/7. So for 1 month, I have already defined the condition. For 4/7, I will define another condition where my due date is different and my percentage and interest calculation methodology is different. Make sense, this one? How do you play around with the condition? If you give me later, you go when you go back, understand some of the case studies and come back with a scenario where we have to do condition that I'll show you exactly with the transaction. But this gives you a good idea of how do you play around with conditions, right? Let's talk about the auxiliary configuration. So here till now we talked about the transaction management, the transaction manager with respect to money market and various product types, transaction types, flow types, update types, condition types. It is not like I will not come on to this after. I will come on whenever there is a reference from these notes. Okay. But for your understanding, this is what we have in this specific section of transaction management from money markets. Now, with this, you can create a deal, right? We just have to assign a common position management procedure for system to understand, because the currency of 1000 was something where the valuation was required. So it was euro and we did a USD. So position management procedure was required. But if not, then we can save the deal, and the later part of the processes will be like, once you save the deal, once you create the deal, you can settle the deal, which will show once I create the deal itself doing this configuration. After that, you have to post it to accounting. Okay. The initial flows you have to post it to accounting. It depends on the cash flow itself. FX forwards do not have maturity anytime before 1 month, or it can be, but it's in the later date. So FX flows are not posted until maturity. They are valued every month end with respect to the clients, or there can be some charges or commissions which can be posted up. So depending on the instruments, the investment will be posted upfront on the first day itself when you have contracted. So the start date, it will be posted. And the respective flows will be posted on their maturity dates. Okay. Next part is posting. Then is every month and either you have to do accrual, deferral, or you have to do valuation, depending on the nature of the instrument that we have talked about. If there is fixed interest, we do accrual. If there is changes in the price, the structure of the instrument itself, we do valuations. Okay. To facilitate the next part of the process, accounting and all, I've not touched upon certain trivial things here which also helped in creating the deal that I'll do now. And mainly about the accounting processes, this note here, how do you link accounting and how do the system know the debit and credit schema, the accounting schema of the flows that you are going to post is to be driven from here. And how do you manage your position is also to be driven from here itself. Okay, the position management procedure, you might have heard about this thing in TRM. All of these things have to be managed here, which are the next part of the process. Yes, there is an overlap, certain trivial things here and there, accounting codes and all to create the transaction. But generally, your productize the building blocks creates the transaction. This is part of the accounting. How do you post and how do you run the regulations? So let's talk about quickly one by one. The organization, it gives you certain fields, certain ways to define a company code, the additional criteria based on whether the currency, what is the fiscal year variant, how the rate calculations happen. Okay, this is very again primitive and can be different for FX and other calculations once we define it in other nodes. So company code additional settings, the company code, the treasury company code that you have defined. So here I'll quickly define 1000. Let's say I copy this, I quickly define 1000, but with Swift BIC is okay. This is used in MT300 confirmation. So small aspects here are used in different areas. So currency, this company code currency is K4, is euros. Fiscal year variant, you understand, right? The April to May, April to March, or December to January. So this fiscal year variant, common FI stuff. Chart of accounts, your GL chart of accounts, again FI stuff. This is used in MT300. This is your business identification code, the big codes, which are sent in the files, can be payment files as well. These are sent in the files to external counterparties so they can identify, okay, this company has sent it. Okay. This can be your, I think, spot or this thing. Okay. 01M, exchange rates, how much do you understand, guys? The ticker and all, how much do you understand? Daily rates is daily sent by Bloomberg, daily changes for currencies. Month ends are only for month ends for specific NPV processes. For example, you want to calculate month end NPV based on a certain rate, which is only relevant for month end and only changes after the next month end. It is not published on the same day. Okay. Spot rates on spot. There can be commodity prices as well, which are brought in from a third party, which is Bloomberg. It can be Reuters as well. All of this concept is basically about loading a certain kind of a rate. Okay, daily or monthly or spot or commodity prices or whatever it is, interest rate or IHC interest rates or whatever it is. Here we just give that with respect to what rates the calculations will happen, the conversions will happen. Okay, and this is a primitive check. It says use a rate type in financial transaction. Uncheck this and it will, there is another configuration after this which will drive, and if you use this, then this overrides the other configuration. All of this stuff, guys, you have to come, I can only tell you 20%, you have to come and see and then ask me questions in the next session. Okay, if I go through each and every field, this will be 3 hours on the trot on the single screen itself. So just see all of the nodes. I can tell you the functional billing first up. see all of the notes and come back with questions if you don't understand, if you want to understand certain things. Okay, so you can define the status, the field selection here with an identification on the front screen, assign it to different product types. Inside also define it to different product categories as well, the transaction categories or transaction types as well. That this field selection is applicable only on contract settlement, because think of a requirement where a client says, I want to see all the mandatory fields when the status of the deal is contract, because it is not settled yet. The back office is still performing some action. So in this, these fields should be open to change. And after it is settled, nothing should be open to change. So to cater to this requirement, we assign different field status variants to different transaction types. Not the transaction types, the activity category. So if activity is your contract, then this status to be assigned. If activity is your contract settlement, then this status to be assigned. Okay, you can research on this, how this node works, assign field statuses and all. Good to have based on the requirement, client requirements. All of these are okay. Here, somebody talked about the calendar. So with respect to currency, the calendar is defined, and that working day, non-working day check boxes that appeared on the deal itself, right? So that is coming from here. For Euro, EU is assigned, and there is a certain transaction, SCAL. You can see year-wise how many days and how many work days and how many holidays are there. Let's say 2020, 2021, I double click and I see how many days and how many holidays are there, how many working days and how many holidays. Only 2 holidays here you can see, rest all are working days except Saturday and Sunday. Okay. So based on this, system identifies this configuration, comes to this SCAL and finds whether it is a holiday on that day. Weekends are all holidays, Saturday and Sunday. It sees extra holidays as well and throws you that warning pop-up that we saw on that screen. If your settlement date, term end date is or term start date is a holiday with respect to these calendars, it will throw a pop-up. Okay, this is where you define the leading and following currency. If you go to Thomas Cook and say, I need to convert USD into INR, what rate you will get? What is the nomenclature of the rate Thomas Cook will say? Or let's say, just try to answer that. So there is a nomenclature existing in the market that certain pairs are leading and following. Okay. So if USD in the financial markets is a leading pair and INR is a following pair, always Thomas Cook, yes, I say that because this is not a retail conversion, let's say it's an organizational conversion. You do the spot trades on the exchange, they will never say INR USD. They will always say USD INR. Maybe the tool allows you to convert INR into USD and give you the opposite rate, but the financial market will always say a nomenclature which is as per the leading and following. Same nomenclature we bring into the system because this is beneficial for me for certain transactions later and certain reporting aspects. Okay, because if you trade, this is beneficial in market data, how the rates are quoted. If AUD is a leading pair, Euro is a following pair. If the rates are quoted like AUD Euro, it's a direct rate. If Bloomberg sends the rate as Euro AUD or you want to load as Euro AUD, then you load as indirect rates. Okay, the direct and indirect nomenclature comes from here only, the leading and following. Certain currencies like INR as well are illiquid for the external markets. For the offshore companies, these are liquid because the companies are situated in India itself. So these are liquid currencies. Liquid currency for offshore market. But for onshore, certain multinational companies which are outside, INR cannot be delivered because this is highly illiquid. There is a certain arrangement which needs to be done and a lot of money has to be spent to deliver INR to certain clients outside. Okay. That is why INR is a non-deliverable. You must understand from the functional perspective in the market how many non-deliverable currencies are there. This list keeps on changing, but you can try and understand. M by R is a non-deliverable. BRL Brazilian Real is a non-deliverable. Yes, it's a non-deliverable. CNY and CNH, two currencies China uses, yuan and I think H is also there. So one they use for non-deliverable, one they use Korean won and few more which are non-deliverable. So these currencies, if business wants to trade, these cannot be settled. Someone appropriately put it, these cannot be settled. You have to settle in the other currency. Most probably that other currency will be your company code currency itself. Okay. So the settlement happens, the nominal exchange of forwards of the physical exchange of the currencies do not happen at maturity. But I'll talk about this when I talk about forex more. But the uh, uh, plus and minus which is happening out of those outgoing and incoming buy and sell currencies, that cash settlement is being settled. Okay, so the gain and loss is only settled. There is no physical exchange of the currency nominals itself to for the non-deliverable currency. So here in the system we define which are the non-deliverable, and system is automatically able to understand that apply the non-deliverable concept to those kind of deals. Perfect. Release. You might have seen the standard workflows are applied to certain logics in MMFI and other stuff as well. Same thing can be applied to treasury as well. So for example, you created a purchase order. Until that is approved, the good receipt or invoice cannot happen. Okay, or a PR is purchase requisition is created. Until that is approved, purchase order cannot be created. So all of those workflow related concept can be applied to the transaction itself. So what happens is after contract, maybe you want someone to approve it. Okay, in the workflow, which SBWP you might understand, this is your inbox, workflow inbox. The workflow gets triggered through certain workflow event activations and assigning the agents to certain workflow responsibilities and rules. And based on that, the workflow gets triggered. And whenever a deal is created in contract settlement, or you can apply in any other direction as well. You can apply whenever a deal is reversed from contract settlement, or whenever a deal is posted, is created in contract settlement and to be posted for TBV1. So before all of these functions, you can put a workflow and say that approval is required from certain agents. So when the workflows occur, when the workflows are configured, see this is TR deal for the treasury workflows. Then what you can do is you can assign different people that who will approve the workflow. To do that, you have to come to OOCU RESP. You can do this in PFCG, the workflow container and the responsibilities itself as well. But I prefer OOCU RESP. So you can come here and assign different agents for certain responsibilities. Okay. This is purely your technical stuff. I am telling you just to give you an idea, but will be done by your technical team if you are asked to implement something. So now you can see that SAP gave many checks in the primitive treasury, but then certain things evolved which can be done in a certain way as well, in a different way from those primitive checks. I can put workflows somewhere and then I don't need that release checks in the treasury primitive area. Let's say this loan which I did with external counterparty was a intercompany loan between two different subsidiaries. One subsidiary, one treasury, giving a loan to a subsidiary. Okay, then again they will use FTD, fixed term deposit. They can use that, or they can say fixed term deposit is external fixed term deposit. I'll use FTE or FTI. For internal fixed term deposit, I'll create another product type, same transaction types, and I'll use it for intercompany processes. Same kind of recording of deals will happen for the intercompany deal as well between the treasury and the subsidiary. Here the business partner is your subsidiary, but it's an internal business partner. We saw that grouping, right? External number range, external business partner, internal business partner. So we will create an internal business partner similar to an external one, but the banks which will settle it through will be internal only. We'll see this when we come to IHC as well, later, explained logic. But here, we'll create an internal business partner as a counterparty to deal with the treasury itself. Okay. Once we do that, what is the requirement of the treasury is, if we create one deal between the treasury and the internal business partner, the deal should be mirrored or extended to the company code of the subsidiary with the business partner of the treasury also. So treasury wants there should be a two-way agreement, because this is a subsidiary trading, no? This is intercompany trading. So if intercompany trading, then one deal I create with the partner and other deal should automatically be created opposite. Everything is opposite. If I give a loan, the other will be investment. The other will be a borrowing for the customer. When I say customer, this is subsidiary. So other will be borrowing of the subsidiary. Okay. How do you do this in system? That how, when a deal is created, when this deal is created in, for example, in FTD, when a deal is created between treasury and an internal subsidiary, how does the other part of the deal, the second deal, which is in the company code of the subsidiary and business partner as treasury, how does that automatically get created? This is controlled through the mirror functions. Okay. So what I do here is, I say company code 1000 and product type FTD, transaction type 100, activity is 10 or 20 or wherever I want to create the mirror deal. So if I say 10, the mirror deal will get created at contract status itself. If I say 20, the mirror deal will created only when I settle the contract. Okay. So if I say okay, this is activity category is different. So let's say I do add or create. Okay, so I find my product category 510 and I say 10 contract. So whenever I create a transaction in contract status, add or create, a mirror deal will be created with this combination. I have to do more config obviously, but with what counterparty? So let's say, okay, let's say external is our internal only, just for simplicity purposes. So with this business partner, whenever a deal is created, okay, FTD is created by this company code with this business partner, the mirror will attempt to be created. We have more configurations, but it's a start. This is okay. The concept is okay. What is mirror and why it is required? Which is meta text, which is sent when I create this. And if I do the same meta text on the other side of the incoming deal with the with the subsidiary, the same will link the meta text and the internal deal will be created. I'll show you how. It says direction outgoing. Whenever a deal is created from 1000 with FTD and 100, an outgoing deal is created with this meta text, a mirror image should be created in the customer, and then we will do the customer as well. When I say customer, it means subsidiary. In our client, we say customer for subsidiaries. Okay. Same thing. This is outgoing from there. This is defined. Same thing, not map flow type, incoming process data. Same thing if I do here, for example, I do company code, I'm not sure, 1010, let's take, and with the FTD and with the 200, because opposite deal should be created, right? 200 I have not created, so we'll see only 100. Activity 01 add or create category 10, right? Coming from a counterparty of 1000, this is process incoming. Incoming deal to the subsidiary. So coming from a counterparty now, this is difficult. Internal. Let's say this. Hopefully. Okay. Mirror image, create. Okay. So incoming data, which is for the incoming subsidiary incoming transaction in a different company code. See, when we talk about subsidiaries and treasury will have one company code, the subsidiary will have a different company code, and there are business partners linked to those company codes separately. Okay, so when we talk about subsidiary, it will also have a company code itself. So when we do this and save this, the process incoming data by, then you can assign the company code to the partner. This is what I was talking about. How will the system understand? Because you did the deal with 1,000 company code and the partner has 2 million, 20000. Once you do that deal, how will the system understand what is the company code of that 2 million partner? How will I create the next deal if I don't know the company code of that business partner subsidiary with which you did the first trade? To understand that, so what happens is you have to assign 1010 to, let's say, 2 million. One more zero, is it? Yes. And this is how the system will understand that if you did the trade, 1,000 did the trade with this partner, then the other trade should be created in this company code with the partner of 1,000. So that is also needs to be defined. Okay. So this arrangement here, if you see, says if you create a deal from this company code with this partner, an automatic deal will be created in this company code with this partner of exactly opposite nuances. If plus was there, then the minus will be there. If it was a borrowing, then the investment will be there. If it was an investment, then the borrowing will be there. Okay. Any questions on mirror? I've seen for Forex, I've seen for money markets, for listed and OTC. I've never come across a requirement of securities. I don't know why, but never came across a requirement. Maybe clients don't do it. Do you think clients will do it? Securities extending to intercompany? Yeah, so these things, guarantees and LCs, credit, letter of credits and all revolving lines, we manage through MM. That's why we are able to mirror. But some things NCD you are talking about, right? So maybe you do it through securities, you are able to mirror, but I haven't seen it. You can try by yourself, see it, whether it can be mirrored or not. Okay, so we have covered till mirror transactions here of the transaction. These are all nice to have and only based on certain client requirements. Just go back and see through all the notes. So go through these two notes in the general setting, organization transaction management. Nice to have as per the client requirement, whatever they want, not necessary to have. Okay. Next, we will not talk about correspondence, hedge management, exposure management as of now. We will directly talk about the accounting. Okay. Then we will start with your correspondence and exposure management. Then we'll come to hedge management and all. We'll talk about accounting and then we'll see the accounting processes in a deal. We'll complete one deal configuration fully and we'll see end-to-end processes of that deal. Okay. So position posting book value in position currency. So this is your book value accounting symbol. For example, your fixed term deposit post to your assets, right? So this is the symbol and this is the position category that I will be using. Sub-ledger posting in payment currency when it only remains to the sub-ledger. We don't use it normally because this is not FI integration. For example, your customer sub-ledger in FI, it is your customer sub-ledger and vendor sub-ledgers, right? So same way there is a treasury sub-ledger which can be created separately and the posting value can be done to the treasury sub-ledger as well. We don't use it, we have direct integration with FI. Bank posting in payment currency. So this makes sure that your GL is masked and those transit accounts are carried to cash management. So now you have to understand this F111 process. So F111 when it posts, it puts your money, it clears the payment request, it puts your money on the bank transit account, right? That bank transit account is cleared against cash when the bank statement comes in. So that bank transit account here we will define as a masking. It will automatically pick up. If we don't do this, then it is not capable to pick up that masking. Okay. Profit related is your P&L postings, either in the position currency or the payment currency. Okay. In FX, we have, for example, I'm buying USD, I'm selling Euro. Okay, I'm trading USD. My position will be in USD, but my payment can be different. My payment can be in the company code currency itself. Okay, I have the luxury to do that. So all of these things in the position currency and payment currency are with respect to certain instruments, but it's profit related. It should go to the P&L. Other GL posting, you don't want to hit the position, so it will be posted to. You can say this is just like other flows or something like that. Currency swap between position currency payment. This I'm not sure when we use it, but we can check it and then come back later. Text posting in payment currency, again, we don't use it. We only use this bank posting, position posting, and profit related and other GL. Okay, the rest might be used for certain processes, but I've not come across with that. But majority of your scenarios can be catered with only these. Okay, even if it is text posting, I'll not post text posting in payment currency because Treasury itself is not able to understand how the text codes work. So I'll always post that other GL posting in the position currency or in the payment currency if I have to pay it out. Where a client has a position in euro, but they want to create these nodes do not mean that I want to pay in a different currency rather than my position currency. These nodes only say that your profit related posting in position currency, whether it will be created, or in the payment currency, whether it will be created. This drives whether a payment request will be created or not for F111 from the treasury processes. But certain scenarios have position currency is different than your payment currency. The company code currency is different than your position currencies. Okay. So in that scenarios, your position and payment currencies are different. Okay, but here these nodes do not distinguish. That does not cater to that scenario. These nodes are only about whether you want to create a posting in the payment currency that helps you create a payment request, or in the position currency. That will only be the postings to accounting. It will not create a payment request. Next node is your accounting symbol assignment to your GL account. So GL account is here. You can see your accounting symbol is here. We will talk about account assignment reference node once we have that, once we reach that configuration. But you can see this accounting symbol which we created here is now assigned to a GL account. Okay. So this is how the integration of accounting symbol and a GL account works. So maybe very specific requirements like guarantee fee or your down payments of certain. So once I do this, maybe it will create another down payment GLs. It will post to those down payment GLs and you can pay accordingly, partial payment and down payment. But that is still FI concept. You can segregate the postings from treasury to a special GL, but again, it goes forward when the payments or anything is done with respect to the FI concept itself. No? So you try and understand the FI concept first and then come here and see what the postings are. If the postings are certain related to a special GL, then maybe it can be utilized with the FI concept together, integrated. But I don't see, I've not worked on the special GL indicators, how the postings are different. So I don't see, I've done 7-8 clients. I don't see, I've never seen the special GL indicator requirements from anyone. Neither I've worked on, not all fields are used for your processes. Okay. So there can be redundancy of fields as well. So SAP might have given all the checks primitive, but not everything is used because it keeps on getting updated. The things keep on coming in other areas as well of treasury. So it might not be used. I have not used it till now. Maybe I'll not use it in future as well. But if you want each and every field, you have to go and drill down. I can only tell you to 20 or 30% of the overall configuration. You go and see, first time I started my treasury, someone told me there's a transaction manager and money market config. I went into each and every field and try to see that. Okay, so this is your hard work. What you have to do, you have to go to each and every field and try to drill down and see if you want to see. So let's say this is where accounting symbols are defined. This is where these are assigned. This is where it is used to create a package of a posting. Okay. And this is where it is given to the update type to carry it to accounting. This is where it is given to the update type to carry it to accounting. So I can assign my update type. So I can assign my update type to a certain posting spec and I can carry it to accounting. Now, if I don't do that configuration, the posting specs stays in the treasury subledger, but these are not carried to accounting. Okay. Now to answer your question, so let's say this is okay, right? How it update type assigned to the posting spec. For example, this was your interest, outgoing and incoming. This is the posting spec assigned 13100. So how do you check what is the posting spec? What is the postings assigned to my interest flow? You come here, you see the posting spec. You can see the 40 with the bank clearing and your P&L, the interest gain. So this is a positive one. You also will have an interest expense which will be debited. Expenses are debited when increased, right? So 40 with a interest expense, you might have a different accounting symbol, and 50 with the bank clearing. Ultimately, it has to settle with cash. So if you are doing everything from scratch, you need to see the accounting of interest. So how the interest, because there are auxiliary postings in SAP, but final posting from the accountant level, first you have to identify that. For example, interest, if you are receiving, it's a gain, right? So it hits your P&L with the credit, and ultimately it has to come into the cash. So the cash has to be debited. But since auxiliary postings are required, first it will come into your transit, and then it will, through the bank statement, it will be cleared to your cash. Okay, so here you only have to provide the transit. In the same way, interest going out has to be paid through a payment request. Then it goes F111 to a transit, because there are certain phases of the process which are posting auxiliary accounting. Okay, so for example, a deal is created and you have to pay out interest. So you have to do TBB1, and once you start doing TBB1, the interest that entry will be posted to the payment request. The payment request in turn has to be cleared through a payment run to the transit account, and then there is a bank statement process which will clear that transit account against cash. Based on that, you have to define. You cannot directly do the cash here because you have a process to follow after TB1. So that's why based on this, you have to define the account. So update types here are assigned to different posting specs. So this is the flow. This is how you have to build. Why we have different valuation areas? Because we use parallel accounting sometimes, three different valuation areas, for different accounting principles, IFRS or US GAAP or maybe Indian one as well. So for Indian clients. So you can have that requirement. So in that case, you can assign different accounting schemas with respect to valuation areas as well. So you can define whether this is a payment transaction or it is just a posting transaction. So you can see two posting specifications can be defined for one update type in account determination with the help of payment transaction indicator. This helps you to define both a subledger posting and a bank or GL posting for an update type. So for example, this is very specific requirement where you also need to post it to the treasury subledger, and also you want to create a payment request out of the same. So you can have an update type defined with a blank here and same update type defined with a tick here. So your requirement is here you have two valuation areas. You want a single update type in both the valuation areas assigned to two different, you can do in the valuation area itself. No, if you want to assign in a different valuation area, you can assign to a different posting spec in the different valuation area. This you can do. Here you cannot do. Here you can assign only 1 to 1, or maybe with the payment tick you can assign 2. But here you have two valuation areas. One valuation area you have assigned one update type to a posting spec. Another valuation area you can assign your update type to another posting spec. Define reasons of reversal. When you reverse a transaction, you can have certain reasons, and certain reasons are actually pointing to different periods. Okay, so you can define 01 processing error or a user mistake or 04 other reasons, and all of these reasons which are defined, once you try to reverse the transaction, it will come up there. Organization, this is where we talked about the valuation areas. You can define different valuation areas with respect to different accounting principles which you have to follow. You just have to define it here. Every company code is not considered, is not in FI is not extended to Treasury as a company code. Treasury only understands company codes as accounting codes. Okay, so accounting code for a particular company code has to be defined and assigned. We faced this error during creation itself, right? So this accounting code has to be assigned to a company code, created, and has to be assigned to a specific company code if we want to create transactions in Treasury. Then you can assign different accounting codes with the valuation areas. For example, 1000 is liable only for 01 valuation area. It will only follow IFRS accounting. And we can define 1000 for 02 and 03 as well. And we have check set update type level as well for more profundity, if I say so. So for example, you want to stop one flow to post and not the entire company code to post, then you don't do it here. You do it in the other node where we stop the update type to post. Save changes is a no. Okay. Setting and settings for position management procedure. All of the month-end accounting, the regulations that you apply, accruals and deferrals, the valuation is controlled through your position management procedure. In the deal, this position management procedure is assigned, and through that assignment, system is able to identify that what all different month-end procedures or specific procedures are to be applied to that deal. Okay, so common principles are these: your valuation and accrual, key date valuation, accrual deficit, which we'll discuss down as well. And there are other principles as well within the key date valuation. Sometimes we do amortization, sometimes we do spot to spot, mark to market, the security valuation, the FX valuation, foreign currency valuation. So all of this will be defined in your position management procedure with respect to the instrument that it is valid. Okay. Let's go node by node, define and assign valuation classes. So a general valuation class, you have that is what we have seen in the transaction itself, right? In the money market node, we assigned for a product type what is the general valuation class. So all of this stuff is used to understand, to make the transaction understand what will be the accounting and how the, because okay. From this, I'll go again to the account determination node where I'll tell you the account assignment symbol, how it is mapped to the account assignment reference, and how the accounting is actually picked up by the deal. And then it comes to those posting specs and update types to carry it to FI. But let's understand first the general valuation class. So general valuation class we have defined like this. For example, this is fair value OCI PNL, fair value PNL. So this is mainly for your hedge accounting, but for normal money market, I can say short-term investments and long-term investments, or short-term loans, liabilities, and long-term liabilities. Okay. So for example, my loan, it is a long-term investment, or it is a short-term investment, or it is a mid-term investment, let's say. Okay. So I created a general valuation class with respect to how it is going to behave. I created a long-term investment and I created a short-term investment. Two I created. Once I select that in the deal, there can be different accounting procedures applied to that long-term and short-term separately. The long-term ones can go to a long-term GL and the short-term ones will go to a short-term GL. Then we have this concept of once the long term is under 1 year, you have to do the class transfer to put the money into the short term GLs. Okay, so just because we can have separate accounting, we have different general valuation classes. Okay, so we define this general valuation class here. Then we will create a valuation class separately. So a valuation area, for example, let's for the simplicity's sake, we will only take 001 as the valuation area, only one valuation area. Then we have assigned, for example, we have created a header of that valuation class as long-term LC, say. Okay, we will assign that general valuation class. I'll show you the exact which we were discussing. The long-term investments. So we will assign, let's take only one valuation area. We will assign the valuation, the general valuation class to a valuation class. Okay, this makes sense for you. We created a general valuation class, we created a valuation class. Now we are doing an assignment of a general valuation class with the valuation class. Okay, I'll tell you the exact integration when we are on the deal. The valuation classes are picked up by the deal itself. It finds the general valuation class. From that, it finds the account assignment reference. From that, it finds that account determination node, and then it goes to accounting. Okay, so I think this was before the valuation class transfer, current portion handling. But after your valuation class transfer, this has been again a primitive check. So what happens is during long term, when you do a long term investment, a long term, let's say fixed deposit, when it is converted to a short term one, you have to do the valuation class transfer, TPM 15M, and whatever is the book value at that time, you convert that into a short term GL. You post that into a short term GL. The same thing happens for interest postings as well with the current portion. Okay, so interest until that point will go to the long term, and whatever interest is eligible for after that, that will go into the short term. If the interest was at the end of the term, then the to that, and the portion which is in the short term will go to the short term GL. But this is a primitive check before the valuation class transfer. Now valuation class transfer takes care of everything through your derived flows. Okay, lots of redundant configuration here. You can actually go inside and check each and every note, each and every field. But most of the things are not used. The bare minimum is needs to be understood. So I'll quickly jump on to, let's say, the update types on the position change category. For example, you created a custom update type, a custom flow type, which you want that it should change the position. For example, your withholding tax or your interest capitalization, it should change the position as well of the book value. It should get added to the book value if it's an interest capitalization. And if you don't want that to change your position and you just want that to be another flow, just as a redundant flow, you come here and define that. Okay. So for example, you want MM1905 to hit your book value, hit your position. Then you come here and say that it is a direct position change or post your so we'll see what is relevant for, okay, this one, indirect position change for your withholding tax, which will be added into the book value or which will be removed from the book value. Okay, or you want the interest to be capitalized or to be added to the book value. So separate requirements where system has already given you standard position changes with respect to an update type, but only if you have a specific requirement where you create a new flow type or a new update type, you can come here and you can assign it to a position change. If you say no position changes, that is a redundant flow. No changes will happen with respect to the position. Again, this is a complex thing to understand. We can talk about it once we are creating the deal and we are doing actually TPM 1. amortization flows are sometimes required to be spread over the tenure, and they can change the position. So we can come here and assign the amortization flows once we are creating the amortization deal. Let's see the key date valuation. So we have different procedures here which define certain concepts. So we'll see the first thing we'll see is within the key date valuation, the amortization procedure. We'll define one by one all of these 6 or 7 procedures here. Then we will come to the position management procedure. We will define these procedures as steps as required. And then we will assign the position management procedure, or let me show you that and drill down later into this. So define position management procedure and assign. So define position management procedure. For example, I defined 1000 as a position management procedure for my, let's say, MM. IFRS, MM, no amortization, let's say. So I defined this as securities. I need to do OTC, not OTC, but loans, security loans, MM, that is okay. So if I define this as my position management procedure, you can see I have different steps here with respect to certain valuation procedures which will be defined in the key date valuation. That's what we talked about. We will drill down from here. Okay, we'll go to there after we discuss this. So you can define those procedures here one by one with steps. You can say first is this and then is this. For example, security valuation to be called for step 1 and then foreign currency valuation to be called for step 2. Okay. Wherever prices change, we do the security valuation mark to market. Foreign currency valuation is for your currency changes. For example, MM in a foreign currency will undergo the foreign currency valuation. Okay. Security valuation, for example, your forwards have forward prices, those are changing and we are doing it on a month end where the forward price is different for the different date. So for that, security valuation is to be done. But it might be required for a certain procedure that security valuation prices are also changing and currency fluctuations are also there. For example, your, let's say, CCS, cross currency swap. You have the currency risk as well, and plus you have to do the valuation of the swap as well. So you have to do the security valuation as well. You have to do the foreign currency valuation as well. Okay. This is how you assign the steps which we will see in the key date valuation. But based on this only, and if I assign this, I'll show you, if I assign this to a certain company code or a product type, based on this position management procedure will be picked up in the deal, it will be called up, and based on that, these steps will be executed. And these steps, how these are executed based on what parameters is defined in the previous node. So this node is okay. Reverse security valuations, transfer FX valuations. It will only reverse the security valuations, the mark to markets, and the foreign currency it will transfer to the new deal. Transfer security and reverse FX, yes, same way. Transfer unrealized valuation, otherwise identical to 02. So TPM 1 ran for 6 months, let's say, and after that you chose to do a portfolio transfer or account assignment reference transfer. So whatever unrealized was posted to the book values, if it not was a reset method, because I will only choose this if I don't reset the valuations, only then my book value gets hit. Then only I will transfer the unrealized valuation, else everything will be posted to the used components. Post book value to purchase value component, this I'm not sure what it can be, but I think by logic this tells you whether to reverse already done things, already concluded things before, and or to transfer certain things when you make that portfolio or the account assignment reference transfer. In the position transfer, for example, brought about by valuation class transfer or a securities account transfer, the transfer category controls how the position components are to be filled in cases where the target position components do not match the source position components. This can arise when the source position and target position have different position management. So first one, I'll try to explain. First one, you understood that if you want to do some transfer from old position management procedure to the new position management procedure, the first one is always copied one-to-one, irrespective of whether you have that specific procedure in the target or not. So your security valuation is your mark to market. For example, in case of Forex, what happens is I have to, for example, the Forex forward is agreed with and the maturity is 2 months later. I have to do the valuation 1 month later from now. The today's price which was agreed, which is the forward price, which is the forward rate, let's say Euro USD, it was 1.3. Okay. Now, 1 month later, what is the forward price of that of until maturity? Okay, what is the forward price until maturity of that deal? When we say forward price until maturity, it means that, for example, you have agreed with the forward rate at initiation, 2 months was the maturity, but after 1 month, what is the forward rate for 1 month until maturity? Okay. Difference between both the forward rates is your gain and loss, is your security valuation, which is calculated as mark to market. Some clients also do spot to spot, some clients also do mark to market. Spot to spot is difference between the spot rates at initiation and spot rate at valuation. Okay, this is what someone was saying, the swap margin and all of that valuation. The swap margin is nothing but your spot plus swap rate, and based on that the valuation is done. So that is a slightly different concept from mark to market. That is maybe more beneficial if I tell you when I'm talking about hedge accounting. So as of now, you just understand simple market, where a forward or wherever the prices change, you might need to talk about security, but I'll talk about Forex more. So where the prices change of a certain instrument and the prices at initiation and the day of valuation are different. This valuation is carried out and it marks your book value to the market value. Okay. Now you can distinguish. This is on the TPM1 screen itself that you can distinguish whether you want to reset that valuation or you don't want to reset that valuation. Okay. Clients use reset valuation and not to reset the valuation. The only difference is in case of resetting the valuation, your book value is not hurt. Book value remains same. The position remains same. Only in case of without reset, your position is written up or written down. Okay, whatever your book value was of that nominal position, or let's say a Forex forward. So of that Forex forward, 1 million USD, this is what you are valuing. Your position is 1 million USD, will remain 1 million USD if you do it without reset, if you do it with reset, and if you do it without reset, you only post it for the month end and not for the next day, then it will change that position. It will write up based on the gain and write down based on the loss. Okay, so your price type is first, rate or price type. This tells you about your spots and opening prices or bid. So before doing TPM1, you have to do this TPM60, or you can manually calculate NPVs and put in a transaction GB NPV. Okay. So depending on what kind of price type you want, what kind of price type or NPV type you want, whatever you input it on GB NPV, based on that TPM1 will pick up that value and only then create the valuation accounting entries. Okay. So for example, NPV type you selected 001. So you can see that continuous valuation, day-end valuation, continuous. You have seen this JPRX and TPM60 screens, right? So you might see a continuous valuation. So continuous valuation, normally we take up the rates which are provided every day, or these are kind of V rates. We normally do it for the continuous V rates from the Bloomberg. Okay, so provided, let's say every 2 hours, 3 hours based on spot, high, bid, low. So based on that, you can do continuous valuation. The day end rates, your M rates, normally standard exchange rate type, the daily rates. So you can choose to get those rates, end of the day rates, closing rates, and do the valuation based on the daily accounting valuation. You can do the month end as well, the rates which you load only on month end. You can do spot valuation as well. The spot rates which you load daily before the closing and after the opening. Okay, you can see here you have to give certain fields, but you again have to give the NPV type here. Based on that NPV type only, system TPM1 will go to the security valuation procedure and see if the NPV type is 01, only then it will identify a NPV value here. Again, TPM60 and JP-NPV both post to the same table, VTV BAR. You might ask about CVA, DVA, the credit value adjustments, debit value adjustments. So this is for hedge accounting. Normally we use TPM60 CVA. So we'll come on to that. Let's not jump, but only the net present values which you enter here manually, you calculate on Excel and you enter here manually, or you can choose to calculate through TPM60. That will also come into the same table, VTVBAR. But you still have the price types and NPV types. Same on TPM60 as well. You have to give the NPV types and the rate type to execute it. Okay. So everything is seen by TPM1 from that price type, comes to here and sees whether I have to write up, write down, and perform the valuation with respect to that. And what is the rate used for valuation? For conversion, it uses the M rate. Okay, if I say do not realize gain and loss, it means the derived business transaction for the translation will not be carried out, and you don't need to do TPM 18 for these for the transaction itself. Unless this is not checked, what happens is when you create a transaction, this is what we are talking about. Key date valuation is your unrealized part. Okay, these are the month end processes, accounting regulation. Okay, every month end you have to do the accrual deferral or you have to do the valuations. But at the end, due to certain fluctuations, due to certain risk, interest rate, currency, commodity, country, or counterparty leave it aside. So there are certain risks which arises and that results into gain and loss actual. This is your realized gain and loss. If I say do not realize, then that flow, derived business transaction flow in the deal in TPM 13 subledger will not be appearing itself. Only in cases where it was not a reset method and your book value was different. So you cannot simply create the Forex transaction which have not matured yet with the nominal value. You have to transfer the book values. Through certain transactions, I think these are TPM 60s, 63, 63A or stuff like that. I think on securities as well, you have to transfer, you have to do the migration of certain things.
Hey there, looking to master SAP FSCM TRM on ECC? Our course has got you covered. Take it at your own pace on our platform. In this course, you'll dive into SAP FSCM TRM on ECC, your go-to tool for managing supplies efficiently. From ensuring we have enough products to getting them where they need to go, we've got it all covered. Our course is comprehensive, covering everything from the basics to advanced strategies. Crafted by seasoned experts, you're in good hands. Your instructors are pros with years of experience. They're here to guide you through and answer any questions you may have. And guess what? Our students rave about the course. Folks just like you have found it incredibly helpful. The best part? It's budget-friendly, so you can learn without breaking the bank. Ready to level up your SAP FSCM TRM on ECC skills? Sign up on our page now. For more info, head to ZaranTech's website.